Dzień dobry Państwu. Szanowni Państwo, drodzy partnerzy, prelegenci i uczestnicy. Serdecznie witam podczas drugiego dnia Warsaw Passive Investment Conference, a moje słowa kieruję do wszystkich Państwa tu na sali notowań oraz tych, którzy śledzą nas online. Wczoraj, pierwszy dzień konferencji, oglądało blisko 1500 osób. Bardzo się z tego cieszymy i liczymy na nie mniejszą frekwencję w dniu dzisiejszym. Cieszymy się, że jesteście Państwo z nami. W ciągu najbliższych kilku godzin czeka nas solidna dawka wiedzy o pasywnym inwestowaniu. I nie tylko. Z uwagi na naszych partnerów i gości zagranicznych, dzisiejszy dzień poprowadzimy w języku angielskim, poza ostatnim panelem, który odbędzie się po polsku. Ze względów praktycznych nie proponujemy tłumaczenia symultanicznego, ale po każdym wystąpieniu zapraszam Państwa do zadawania pytań. Proszę to robić w takim języku, w jakim będzie Państwu najwygodniej. Postaramy się przetłumaczyć, najwierniej oddając intencje autora. Liczymy na dużo trudnych, ciekawych pytań do naszych prelegentów. Pozwolę sobie teraz w języku angielskim powitać naszych zagranicznych gości, partnerów, przedstawić skrótowo plan dzisiejszego dnia i poprosić Panią Prezes Izabelę Olszewską o oficjalnie otwarcie tego dnia konferencji. Dear participants, speakers and partners, good afternoon and a very warm welcome to the second day of the Warsaw Passive Investment Conference. I'd like to extend my greetings to all of you in the room, as well as those who are joining us online. We had almost 1,500 participants following us online yesterday, and we are counting on a similar number today as well. It's a pleasure to have you here with us, and we have an exciting schedule ahead. Over the next few hours, we'll be delving into the world of passive investing and beyond. In just a moment, I'll be inviting Mrs. Izabela Olszewska, member of the Management Board of the Warsaw Stock Exchange, to officially open the conference proceedings for today. Following her speech, we'll be hearing from representatives of our partners who will share their insights on the index replication methods, trends in the commodities market, and the use of ETFs in investment strategies. After these presentations, we'll convene a panel discussion on the current state of passive investing and the trends shaping the industry worldwide. Later in the day, we'll be exploring the concept of impact investing and sharing some concrete data and experiences from our partners. Towards the end of the day, we'll conclude with a panel discussion on the future and development on the Polish passive investment market. Afterwards, we'll invite you to join us for an informal networking session and the toast to the conference. We hope you'll stay with us until the end and enjoy everything the conference has to offer. During the day, we'll invite you to 2 coffee breaks to make sure that you maintain appropriate level of energy and enthusiasm. Please note that we'll be conducting the conference in English, except for the final panel discussion, which will be in Polish. And please bear with us. We would feel uncomfortable discussing local trends and markets in a foreign language. You are, however, very welcome to ask any questions you may have. Translation will be provided if needed. Once again, a very warm welcome, and I hope you have an engaging and informative day. I'd now like to invite Mr. Izabela Olszewska to formally open the conference.
Good afternoon, ladies and gentlemen. Dear guests, our business partners, dear colleagues, it's my pleasure to open the second day of today's edition, the 4th edition of the conference, Warsaw Passive Investment Conference, an event which is fully dedicated to passive investment and especially to exchange-traded funds. As a board member of the Warsaw Stock Exchange, I'm really delighted to see so many partners here with us today, both local partners and on the international level. From the very beginning, the Warsaw Stock Exchange has been organizing this conference together with the most important institutions on Polish market, which are involved in development of passive investment in Poland. I mean here mBank Brokerage House, a leader in the Polish market in the sales of ETFs, and Vita Securities Poland, the creator and issuer of the first Polish exchange-traded funds. This year, we are very proud to see also other prestigious partners, including the Polish Chamber of Brokerage Houses, Association of Individual Investors, and CFA Society Poland. For the fourth time in a row, foreign entities, recognized issuers of passive investment products, have joined the group of conference partners. We appreciate Invesco, which is the main partner of this year's edition. We are also thankful to our supporting partner, WisdomTree and BlackRock, who have been with us for previous edition already. We also appreciate and welcome a new partner which joined the conference this year, DWS Xtrackers. Passive investment products such as ETFs, they have enormous potential to grow, and it is shown by international trends and statistics. There are currently near 9,000 ETFs listed worldwide, and after another year of high inflows, as of the end of the previous years, 2022, nearly $10 trillion was accumulated in these funds. As the Warsaw Stock Exchange, of course, we recognize these opportunities, and continuously we are working on the development of the Polish capital market and products offered to our investors. This conference is a proof of our efforts and the essential part of these efforts to promote and educate in the area of passive investment. Also, the development of ETFs and other passive investment products, it is the main topic of capital market development strategy. This is the national plan created and being managed by Polish authorities. The year 2022, marked by the war in Ukraine and its wide negative macroeconomic consequences, was an extremely challenging year for us in Poland, but also for other financial markets globally. Major stock and bond indices recorded very painful declines. However, last year turned out to be the record-breaking in terms of investor activity in the ETF segment listed on the Warsaw Stock Exchange. The total turnover of these financial instruments exceeded, first time in our history, 1 billion zloty. However, in Poland, we still face some challenges which are connected with the regulatory framework, and still the challenge remains in improving this framework, these regulatory frameworks, for the issuance of ETFs in the domestic market. The Warsaw Stock Exchange is committed to expanding the range of passive investment tools accessible in Polish currency, such as exchange-traded funds, exchange-traded notes, and exchange-traded commodities, to provide significant benefits to our local investors, both retail clients and institutional investors. We are frequently asked by our clients about new ETFs during our trainings and conference sessions, and therefore we strive to develop the market for such products to fulfill our investors' demand. I very much hope that the knowledge and insights gained from this conference, Warsaw Passive Investment Conference, will help all of us to better navigate the complex world of passive investing and enable more informed investment decisions. I would like to wish all our guests, participants, partners, distinguished panelists, an exciting and successful the second day of our conference. Thank you very much.
Thank you very much for this official opening and for already sharing some interesting insights about the Polish markets and not only. We are now ready to begin the first presentation from the representative of our conference's main partner, Invesco. And it appears there'll be a very interesting presentation indeed. Before we move on, let's go back to the structure of ETF funds and the replication methods, which is the topic that have been quite hot among the investors for quite some time already. It sparked discussions from supporters of a strict physical replication, claiming that it alone provides real investor safety, to those who argue that it doesn't really matter so much. And after all, can a large index be replicated solely physically? And what if it doesn't pay off at all, as being impractical or simply too expensive? And how can we actually find a middle ground here? Ewa Miklaszowa, who's the head of ETF business for Austria and Central Eastern Europe at Invesco, has prepared a very interesting presentation for us that will shed a light on these and some other questions. Ewa is actually a frequent visitor at our conferences and a highly appreciated one. We are eagerly awaiting your presentation. Ewa, the floor is yours.
So thank you very much for a very nice introduction. Good afternoon to all of you here in person, and as well, good afternoon to all of you online. My name is Ewa Miklaszowa, and I am head of ETF Business Austria and CE at Invesco. We as Invesco, it's our pleasure to be here today as a main partner, and we're really looking forward to speak to all of you during the coffee breaks. Before I start to talk a little bit more about ETF costs and application methods, let me introduce Invesco as a company. Invesco is a global, leading and independent investment firm with over $1.4 trillion asset under management. We managed active mutual funds, solutions, mandates, and of course, ETFs. Regarding our ETF business, we are fourth largest ETF player globally with over 400 ETFs available on the market. Did you actually know that in January this year, we celebrated 30-year anniversary since the first American ETF? Since then, a lot has happened in the global ETF market. Looking at the left-hand chart, global ETF market has been growing rapidly over the last 10 years. Now we have, by end of 2022, over $9 trillion asset under management. So, which means global ETF market has doubled more than every 4 to 5 years. Looking at the middle chart, EMEA ETF market has been growing as well rapidly over the last couple of years. 2021 was a record year regarding net new assets in the EMEA UCITS ETFs, with almost $200 billion. 2022, despite the turbulent market, is still pretty good regarding net new assets into the EMEA UCITS ETFs, amounted to $87 billion. And since beginning of the year till 20th of April, we saw inflows of $51.7 billion in EMEA UCITS ETF market. And from that number, around 17% went into global equity ETFs, 18% in emerging market ETFs, and then around 13.5% in European corporate bond ETFs, and over 9% in single and broad commodities. So now looking at the right-hand chart, according to the asset classes, obviously equity ETFs are the biggest part with 68% asset under management. On the second place is fixed income ETFs, which is with 24%, and commodities are with 8%. Now let's talk a little bit about costs. Because we know, all of you here, that ETFs is the new modern structure, which is very cost efficient. And the total cost of ownership by investing to ETFs, we can split them to two main costs. The first one are holding period costs. The second one are implementation costs. So holding period costs. These costs are relevant for all investors, actually, since the moment you are already invested till the moment you decided to get rid of your ETFs. So these are the most popular: management fee, ongoing charges, tracking error, rebalancing costs, swap fees, taxes, and so on. Then the second cost, which is as well as important as the first cost, are implementation costs. So typical trading costs, how to enter ETF and how to efficiently exit the ETF. And these costs could do as well huge difference by investing to an ETF. And this is very important to us at Invesco to support our investors, our clients, by entering and exiting our products, by preparing pre-trade analysis for them, looking at the quotes, because the trading of UCITS ETFs in Europe is a little bit different to trading the US ETFs, because majority of the trades are not on the stock exchange, so are done OTC via the market makers or APs. So it is important for us to support our clients to get them the best and most efficient quotes. And for investors who are investing long-term into ETFs, obviously the holding period costs are more important, but for the traders who are trading pretty frequently, are the implementation costs more important. So let's talk a little bit now about the holding periods costs. What is the true cost of the replication? The first one, pretty obvious one, are the management fee and ongoing charges. So these are the one you are probably looking at by selecting an ETF. These include like management fees, custody fees, admin costs, and so on. But these are not all potential costs. Then the second one are transaction costs regarding the rebalancing of the ETF, probably swap fees, and this could have large impact and are not included in the ongoing charges. Then obviously tracking error, so which is how consistently an ETF tracks the index. And then withholding tax rates cost. And this one are for a lot of investors still not very familiar. And this is why I would like to talk today mainly about these kind of costs by investing into ETFs. And with that one, when you have lower than standard withholding taxes on dividends, which are obtained by the fund, it can lead to outperformance. And this outperformance could be around 40 basis points, which shouldn't be ignored because it's a lot. And then, of course, at the end, stock lending revenue, which can improve the performance of the ETF. Now, let's look at the withholding tax costs with one example, S&P 500 index. So usually when you invest, or when investor invests into US ETFs, the ETFs which are tracking US regions like S&P 500 or MSCI USA, NASDAQ 100, or so on. So the withholding taxes on dividends are automatically deducted by investing in the net return index or indices. And the standard net return index assumes 30% of withholding taxes on dividends received by the funds. So, and you have now actually two ways how to manage this cost and how to decrease this cost connected to these withholding taxes on dividends. The first one is domicile of the ETF. So you can select the right domicile and you can actually decrease the costs. And the second one is the selecting right replication method by selecting an ETF. Let me first talk a little bit about the domicile. So the domicile you can easily identify by looking at the ISIN of the ETF, and specifically Irish domicile funds only pays 15% withholding taxes on dividends, which is half of the original 30% because of the US-Irish tax treaty. So just by selecting Irish domiciled, for example, S&P 500 ETFs physically replicated, you can already actually save half of the withholding tax. And let's look at this on the right-hand chart. So what you can see here is graphically what actually it means for your performance. So calculated to 0, you can see S&P 500 net index. Then we actually created this index with 15% tax, which is with the blue line. And then we took two physical UCITS ETFs, which are the biggies on the market from the largest ETF providers on the market. And what you can see here, that this physical replicated ETFs with Irish domicile and the 15% net index is outperforming S&P net return index, just by selecting the right domicile. What it means for performance, so performance-wise, you can actually save around 20 basis points. So outperform the net return index by 20 basis points. Now let's look at the second option, how investors can manage withholding taxes costs, how they can decrease the cost. The second one is by selecting the right replication method. And the replication method called synthetic replication. We call it an Invesco physical replication with swap overlay. So what does this mean? With this replication method, you can actually decrease the withholding tax cost to 0. From 30% to 15% by Irish domiciled and to 0 by selecting synthetically replicated ETFs. So let's look at straight to the chart on the left-hand side. What you can see here again is S&P net return index. Then you see the 15% tax net index. And then you see 3 synthetic replicated ETFs from the largest providers, the largest on the market. And obviously you can see that the 15% net return index outperformed the S&P net return index, and all the synthetic ETFs are outperforming then the 15% net return index because of the replication method. You see, of course, the differences between the ETFs. You see that ongoing charges are a little bit different. The tracking error is as well very low. So it makes difference to select by which asset manager you select the synthetic replicated ETFs, because every asset manager have different costs, have different little bit structure, different tracking error, and so on. And what you can see now, the exact calculation, how we actually calculate how much you can save on these withholding taxes. You can see it here on the right-hand chart. So let's assume that the dividend yield is 1.68%. Then the standard withholding tax is 30%. So you calculate actually that without any cost, you can save 51 basis points. Then you deduct the cost, you deduct the ongoing charge, you deduct the swap fee, and actually your outperformance between the net return index is 42 basis points. And 42 basis points by S&P 500 index is a lot when you compare that the fees by S&P 500 are around 5 to 7 bips. Now is the question, so okay, understand, but why? By the Irish domiciled, the question is clear. There is this US-Irish tax treaty. That's the reason. So how it is with this synthetic replicated ETF? There is not anymore very new, but still not very familiar regulation for a lot of investors, so-called Hire Act 871M in US. And this Hire Act made clear that all swaps which are written on indices with liquid futures market are exempt from withholding taxes. Maybe I can tell you a bit brief background about this regulation. So this regulation is valid since 2017. And in the past, obviously, you don't pay any taxes, withholding taxes on dividends when you are using futures. But in the past, you had to pay the taxes by using swaps. And the US regulation wanted to make this tax regulation fair. That's why they decided that as well swaps, which are OTC derivative contracts, are exempt from the withholding tax on dividends. So this is the reason why actually synthetic replicated ETFs are exempt completely from the withholding tax. And obviously, the synthetic replicated ETFs, they consist of the basket of securities, and the index performance is swapped with the basket of security. And that is where the swap is used by this replication structure. I will talk about this in a couple of seconds. So now, how synthetic replicated ETF works. So we know what are the benefits now. So let's look at how this works, because physically replicated ETFs is pretty clear how that one works. So the first step, and now just a note to this, I am now going to describe the process we are using at Invesco. And I would like to as well stress that every asset manager have a little bit different process, different risk management, different management of counterparty risk, different basket compositions, and so on. So today I will introduce what we are doing at Invesco. So the first step, what we are doing is that ETF owns actually a basket of high-quality developed market securities. And this basket doesn't have to be exactly the same as the index ETFs is tracking, which means you can have in the basket a little bit different composition of the stocks, the weights could be different. Which is important to us at Invesco is that the basket has high-quality stocks which are liquid, and all the stocks have to be listed on the stock exchange. And we are looking at the, first of all, correlations. So the basket have to have a very high correlation to underlying index. The second, diversification. The basket follows usage rules. The third, concentration limits. We are really looking at that we don't have any concentrated positions in the basket to manage the concentration risks. And the last one, very important, liquidity. That the stocks are liquid, are listed on the stock exchange. Then we have the basket, which is not exactly the same as the underlying index, but we need the performance of the index. So what we do as a second step, we swap the performance with total return swap with investment bank, which means we are sending performance of the basket to the investment bank, and the investment bank is sending us the performance of the index. What it means, then as you include investment bank to your formula, you have kind of counterparty risk. And it is very important and crucial to manage this risk. What we are doing here, how we manage this, is that we use multi-swap counterparties. That we don't rely just on one bank, we are using a couple of banks. And it is usually, depending on the ETF, it is between 4 to 6 investment banks. There is committee at Invesco who is selecting which investment bank have a contract with us. There is credit assessment of the investment banks. So we are looking at the Standard & Poor's, Fitch, and so on ratings agency. It has to have rating A2. And we are doing continuously credit assessment and ratings of the investment banks. And at the end, we can achieve very precise replication and then minimal counterparty risk, because usually in the market, when the volatile are not too high, we have around 99% in the physical basket of the securities, around 1% is this total return swap. And this 1% total return swap is split into 4 to 6 counterparties, which makes around 0.2% counterparty risk per one counterparty. But the risk management and the risk mitigation goes further in the process. So after we select the banks, do the credit quality check, after we make sure that the banks are diversified, then actually the question is, when the ETFs have this slight counterparty risk? And it is only in the case when the index owns us performance. Because when the basket is outperforming the index, then we own money to investment bank, no problem at all for us. And statistically, it is like 50-50. 50% of the time, we own the performance, 50% of the time, plus minus, bank own us performance. Which means, in the 50% of the times, we need to make sure that the counterparty is delivering us performance. And when actually we have the risk, it is in the time when the swap has mark-to-market value. This is why it's very important to have very strict reset criteria. And we identified following limits. So first of all, exposure to a swap counterparty is resetted when the nominal value is 400,000 euro, then or 0.2 of fund assets, or 4.5 of swap notional. These are very strict criteria. The second, then, when there is some creation or redemption mechanism in place, or when the markets are very, very calm, and after 30 days pass since last reset. And here, because I mentioned the calm period, no volatility in the market, no problem, we are showing you here an example of the volatility, of the volatile markets, what's going on with the swap mark-to-market value when the markets are a little bit more volatile. And here you can see the example of the first quarter 2022 during the shock of the COVID pandemic. You can remember the markets been dropping down and then recovering pretty quickly. So here you can see the first quarter of the mark-to-market value. So what you can see here with the dark blue line is regulatory limit, what is the maximum of the swap notional product could have, which is 5%. Then you can see this, what I already mentioned, this 4.5, our limit, what is the swap notional. And I mentioned that usually the swap notional is around 1%, but when the markets get volatile, and during the first quarter of the COVID pandemics, it was 2.5%. Still much below the limit we have set up. And the second important information is as well that at least 3 of the 4 counterparties reset on almost all days, but on 5, in the first quarter, the swaps. So, bottom line, it went pretty smoothly. And to summarize this, so for me as an investor, it is pretty attractive risk-reward because I can earn actually 40 basis points in comparison to net return index, depending on the dividend and on the index. Let's assume this S&P 500 net return index example. And I'm taking slight counterparty risk. So what is the worst case, really like the worst case scenario, what can happen to me? So first step is that actually all the banks get bust. And imagine what happened when Goldman Sachs, JP Morgan, Morgan Stanley, and this bank collapse. I think then we have completely different problems than the replication method. The second is that the swap is not resetted. And there are very strict criteria that the swaps are resetted. So as soon as you reset swap, you don't have any risk anymore. Swap needs to, again, have the mark-to-market value. And then actually you end up with a basket of physical stocks, which is correlated to the underlying index and so on. So your risk is actually that your tracking error increase. That's all the risk you are actually taking. And in case that something happened on the market, some unimaginable scenario that the synthetic replication is not possible, then we can switch to physical replication. I mentioned S&P 500 as a main index to actually make my point during this presentation. But it is not just S&P 500. I told you that this tax regulation in US is for every liquid, deep future market. So as well for MSCI USA, you see the same, that the synthetic replicated ETFs outperform the physical one and the net return index. The same for S&P 500 ESG or S&P 500, S&P 600, as well even for MSCI World, because you have still around 60% in US in that index. Even for NASDAQ. And you can see here that, again, you have here physically replicated NASDAQ 100 ETFs, then you have a couple of synthetically replicated NASDAQ 100 ETFs, and then you have the NASDAQ 100 net total return index. And as the NASDAQ is a little bit more expensive product, so the ETFs usually cost between 20 to 30 basis points. So here actually, by selecting the synthetic replication method, you can pay for your costs, what you are actually paying for the NASDAQ 100. And to finalize my presentation today, I would like to maybe mention a couple of points why Invesco is a good partner for the synthetic replicated ETFs. The first reason is that we have more than 10-year history in synthetic replication and expertise. Second, we capture major inflows into synthetic replicated ETFs, and we have actually the largest UCITS S&P 500 index replicated ETFs synthetically on the market. And we have very strict counterparty risk management risk criteria, strict swap reset criteria, very strict basket composition, so the risks are very well managed. And at the end, we have over 60 synthetic replicated UCITS ETF on the market. And with that, thank you.
Thank you very much, Eva, for yet another insightful presentation at our conference. And needless to say, you set the standards very high for others and for yourself next year. We all kind of realize the importance of costs, but hardly do we see that being described in such a great amount of detail, so thanks so much for that. We are a little bit behind the schedule, but I will take at least one or two questions to Eva, if there are any.
Happy to take any questions, in case we can discuss during the coffee break.
Thanks so much then.
Thank you.
We are moving on now to a presentation of another representative of our conference's partner. And this one will be about commodities. And the subject of commodities in passive investing has been gaining momentum for quite some time now. And we are all aware that ETFs in the European Union are restricted to mainly equities and bonds due to some regulatory reasons. But what if we do require commodities in our portfolio? Yesterday, Mariusz Adamiak discussed the instruments available on the Warsaw Stock Exchange to invest in commodities. And today we will delve much deeper into this topic. Mowinta here, a director of for macroeconomics research and tactical solutions at WisdomTree, will discuss the interesting topic of investing in commodities from the perspective of the energy transition. what impact will the energy transition have on the commodities markets? And are we currently in a commodity supercycle? Mobin has prepared a very interesting data to answer these questions and discuss the topic in detail. We are very much looking forward to your presentation. Please just grab any mic.
Let me give you 3 examples, recent examples of times when 3 different commodities rallied for 3 very distinct reasons. Example number 1, September 2019, Indonesia announces an export ban on the export of nickel ore. Nickel ore being the raw form of nickel. Now, Indonesia is one of the biggest suppliers of nickel worldwide, and the country announcing a ban on the export of nickel ore suddenly told the markets that the market is going to be undersupplied, there's going to be tightness in nickel supply, and therefore the price of nickel rallied. Consider example number 2. Start of 2021, there's an outbreak of swine flu in China. Now, China is one of the biggest consumers of pork, and the outbreak of swine flu in China suddenly meant that all the pork being produced domestically can no longer be consumed, it'll have to be imported. Suddenly the price of lean hog futures rises. Consider example number 3, and this one is more recent, of course, in 2022 with the conflict in Ukraine. What happened? An energy crunch resulted, and of course, natural gas prices went up because everyone was looking to secure natural gas from elsewhere. 3 very distinct examples. In each of those cases, the price rallied very quickly, and perhaps after the event came back to normal, if you like, pre-event levels. If you were tactically inclined to capture that performance, you may have done well to time the entry and the exit, but of course that would have been difficult. What if instead there is an opportunity to capture a trend that lasts not weeks or months, but years? What if it lasts 5 years, 10 years, more? Now, as professional investors, we would tell ourselves, there's no way we're going to miss a trend that lasts 10 years or more. So the question is, are we beginning to see the start of such a trend? Are we in a commodity supercycle? Now, in the last decade, in the previous decade, the 2010s, there wasn't much talk about a commodity supercycle because look at what commodities were doing. So the gray highlighted bit shows the relative performance of commodities compared to other conventional asset classes. And we can clearly see commodities were not hugely impressive. 2013, 14, 15, in the middle of the decade, slightly better performance, but nothing particularly to write home about. 2016 was an anomalous year, strong performance relative to other asset classes, but again, that wasn't sustained until the pandemic happened. And of course, in 2021, 2022, the strong performance was actually repeated for 2 consecutive years. And this term, supercycle, started to trend in the investing circles. Are we in a commodity supercycle? Is the asset class back? So the question now is, if this performance is going to persist for 5, 10, 15 years, maybe more, what are going to be the drivers of it, and which parts of the commodity spectrum might benefit? We believe that the energy transition, if we are going to go into a commodity supercycle, the energy transition will certainly have something to do with it. Consider, no matter where you look in the spectrum of energy transition applications, so at the top you see various things that we need to build in order to make the energy transition a reality. So at the left side of the chart, we highlight some battery-related applications, so batteries, electric vehicles, energy storage systems, and you see some familiar names, copper, aluminum, nickel, zinc, as being very important in making those applications. Some perhaps less familiar names, and this is an opportunity for you to test your periodic table skills. If you still remember some of those less familiar names on the list. But of course, not all markets are investable. So as an ETP provider, an exchange traded product provider, it is our job to identify the investable commodities from that list. But the point being that no matter where you look, there is some sort of a mined commodity being used. Look at wind, look at solar power, look at hydrogen electrolyzers. The production of hydrogen requires platinum, something we might not have considered otherwise. So each of these applications has some sort of a mined commodity in use. Let's put some numbers around that story, and let's compare how much demand some of the familiar commodities had in 2020 versus how much demand they will have in 2050 if we are to achieve the 1.5 degree scenario. So in a 1.5 degree scenario, take copper as an example. The annual demand of copper rises to 68 million tons by 2050. In 2020, it was only 28 million tons. So from 28 million tons per annum, we're going to 68 million tons in the span of 3 decades. And this demand is being driven by all of these applications like charging infrastructure, electric vehicles, energy storage systems, solar and wind power. The only space where there's a negative number, that is, the demand for copper is actually coming down, is internal combustion engine vehicles, because we'll probably be producing less of them by 2050 compared to today. Similarly, the effect is similar with aluminum, nickel, cobalt. With lithium, it's interesting because lithium is, of course, a smaller market compared to copper, much smaller market. So the multiplicative effect is even greater because of the demand in electric vehicles. So lithium is going from around 0.3 million tons to well over 4.5 million tons per annum. That's the demand. What about supply? Is there enough of these materials being produced to meet this demand? The answer is no. So based on current levels of production, by 2030, we are most likely facing supply shortages or supply gaps, as the chart shows. So supply gap in percentage terms is how much shortage relative to demand is there in percentage terms. And we see that for each of these commodities, we are facing a supply shortage within the end of the decade, by the end of the decade. And of course, if we are going to target a 1.5 degree scenario, which we ought to, the gap widens even further because we need to produce more energy transition applications, more clean energy to stay within a 1.5 degree scenario. So what do we need to do? We need to invest. We need to invest in more capital expenditure going into mining of these materials. In the previous decade, the trend has generally been downward. So we see that capital expenditure going into mining activity has been on the decline. Why? Well, because the price incentive has just not been there. The demand incentive has just not been there. We saw at the very first slide that commodity prices were weak, and therefore that didn't necessarily incentivize the investment into new mining of these materials. Whereas now, with the energy transition, where demand suddenly breaking that trend, supply is being incentivized as well. So again, if we continue along the current path, supply continues to decline and we face those supply shortages, but we need to break that trend if we are serious about the 1.5 degree scenario. And the reason why there's this sense of urgency to do that is because you can't just invest in a project and expect new supply to become available overnight. For most of these projects, there is a lead time. You plan for a new mine to become operational and for it to actually start giving you usable supply of these materials. Sometimes you're looking at 6 to 8 to 10 years, depending on what commodity you're actually investing in. So again, if we're looking at 2030 as the point that we need to have addressed that supply deficit, we need to invest today because otherwise we'll be facing shortages. Now, China, of course, since the start of this year, there was a lot of excitement about China being that catalyst that might lift commodity prices once again. A lot of interest certainly in January when people were very excited about the potential demand impact on copper and so forth. Then in February and March, a lot of investors were a little bit disappointed because the economic data just wasn't coming through from China. But now in April, that's starting to change again. That economic data is beginning to come through. And of course, China is very important in any commodity conversation because it is by far the biggest consumer of commodities worldwide. So on the chart here, we show the percentage consumption of China in a number of different commodities relative to the largest economy in the world, the US. And we see that Chinese consumption completely dwarfs the consumption of the US in pretty much all of the commodities shown here. So China growing at a time when the rest of the major economies elsewhere are facing the prospect of recession could be a very good stabilizer, not just for the global economy, but of course for commodities demand. But of course, historic patterns aren't going to trigger a super cycle. If this was enough to trigger a super cycle, it would have triggered a super cycle already. What might change is what's happening on the regulatory front all around the world. In the US, we know that the Inflation Reduction Act has come out. The Inflation Reduction Act, we can see, is very heavy on a number of clean energy applications. So we see the subsidies for electric vehicles, clean energies, energy storage, hydrogen, batteries and renewables. A lot of investment that wasn't there before, and of course Europe will have to respond with something comparable, otherwise they will lose their competitive edge. China is investing themselves in the energy transition. And the regulatory support, in our view, really paves the way for all of these industries to truly thrive. And when those industries will thrive, they will demand more commodities. And so this could be that turning point for commodities demand that we have not had in the past. In Europe, we've got the emissions trading scheme. So the regulator is putting a price on greenhouse gas emissions. This is a very encouraging thing because it's making it more expensive to put greenhouse gases into the atmosphere. This chart is showing the price of those emissions over time. So in 2017, the price of putting 1 metric ton of CO2 or CO2 equivalent was around 5 euros. Today, it's close to 100 euros. Is that chart ever going down? Well, hopefully not, because that would defeat the purpose. The whole purpose of this enterprise is to make it more expensive for industries to pollute. And how is the regulator doing that? It's doing that by design increasing demand. So how can the regulator increase demand for carbon allowances? Well, they can include more sectors within the regulation. So shipping, transportation, buildings, those sectors that weren't covered in the past will, by regulation, need to hold allowances for their emissions. That's increasing demand. And they will decrease supply just by issuing fewer of these things. So there will be fewer allowances in circulation, and there will be more people demanding these allowances. So what will that do? It'll push up the price of these things. But that's a good thing. That incentivizes industries to move towards cleaner technologies. Because at some point, the price of emitting becomes unsustainably high. So what do? You look elsewhere. You might as well move towards clean sources of energy, like wind and solar. Wind and solar are interesting because they're at a point where they are mature enough to have acquired economies of scale and see significant cost reductions, but they are nascent enough to still expect strong growth potential in the future. It's a very interesting point for wind and solar. And by 2026, 2027, the IEA, the International Energy Agency, they foresee that wind and solar could overtake the cumulative share from sources like coal and gas in our energy mix, in the global energy mix. Now, we were, a few days ago, we were shooting a video in our office talking about the energy transition, and someone joked that it's fine to be talking about the energy transition sitting in the office, but wouldn't it be cool if we did a video with me abseiling down a wind turbine? I said, sure. So maybe you see a video from Wisdom Tree at some point with me abseiling down a wind turbine, if I'm brave enough. That's not me for now. The purpose of that picture is to illustrate how big these things are. You could be on a plane and you can see them from a distance. Wind turbines are absolutely massive. The wingspan of some of these things can be larger than a football field. But not only that, these things are becoming bigger. By the end of the decade, they will probably double in size. So each wind turbine will probably double in size. And the reason why these things are getting bigger is because it makes sense to make them as big as possible. Out in the sea, you have more space, you have more wind, so you might as well make your turbine as big as possible to get the most bang for your buck. So wind turbines could double in size and attract $1 trillion USD by the end of the decade. There are also some very interesting innovations happening in the space of wind. For example, floating wind. Floating wind is exactly what it says on the tin. Instead of planting your wind turbine at the ocean bed right next to the shore, why not let your wind turbine float on the water? And what it allows you to do is, it allows you to take your wind turbine further into the ocean, where conditions are as windy as possible, and you can move your wind farm to windier conditions and extract the most benefit from offshore wind that way. And you're not limited to looking for spaces where the ocean bed is shallow. Why is this exciting in a presentation on commodities? Because if you just look at the metal intensity of things like offshore wind and compare that to the metal intensity of some of the incumbent energy sources, there's a huge difference. So compare how much copper is required in coal. Now, we're comparing apples to apples here. So for each megawatt of energy generated from coal versus each megawatt of energy generated from offshore wind, this is how much metal you need. So we see for coal, the amount of copper is around 1,000 kilograms, whereas the amount of copper in offshore wind is nearly 8,000 kilograms. Nearly eightfold increase in how much copper you need to generate cleaner form of energy. Electric vehicles. Electric vehicles reached an interesting milestone at the end of 2022, 1 trillion USD in sales. 1 trillion. More than half of that 1 trillion came in the preceding 18 months. That's how quickly the trend is accelerating. It was interesting at the start of this year, if you were following Toyota's updates, there was news coming out of Toyota saying that the CEO at the time, he voiced skepticism about electric vehicles, and then a few weeks later, he resigned. So someone probably from the board sat down with him and said, "Thank you, sir, for your service, but we need to have a strategy in this market because clearly we've missed out on $1 trillion opportunity here." Why are electric vehicles so important in a presentation on commodities? Again, every single electric vehicle compared to a comparable internal combustion engine car requires 6 to 7 times more metal to make. So again, we see 3 to 4 times the amount of copper, and similarly with lots of other metals like lithium, cobalt, and so forth. So as the world makes more electric vehicles, as the world looks to charge those electric vehicles and hopefully run them on renewable energy, all of these things will require more commodities. And these are sources of demand that just weren't there in the past. Battery storage, of course, you don't want your electric vehicle to be running on fossil energy. You want it to be running on renewable energy. Now, renewables are an intermittent source of energy in that what happens when the sun isn't shining and the wind isn't blowing? Well, ideally, you've got an energy storage facility that can store energy that you produced on a sunny day or a windy day. And the International Energy Agency foresee that by 2030, we need energy storage capacity to increase by a multiple of 17 if we are to remain on track for our net zero targets. But of course, commodities are still a cyclical asset class. So we can talk about these long-term and exciting stories, but then you might say, Mubin, you're telling us that there's strong demand for these industrial metals, but I can see industrial metals are still down year to date. What's going on? Well, what's going on is commodities are still a cyclical asset class, and they aren't immune to what's happening in the global economy. They aren't immune to what the Fed is doing. They aren't immune to the prospects of recession. And those sorts of things are being priced in today. The energy transition is not being priced in today. It was interesting conversations with investors in 2021 when commodities were doing very well. Many investors asked us, is the energy transition, when we used to talk about the energy transition and show similar charts 2 years ago, investors used to ask us, is the recent price performance telling us that the energy transition story 10, 20, 30 years from now, is that priced in today? And we said no. What's being priced in today is just COVID lockdowns and supply tightness. What might happen to prices in 20 years, 30 years' time, and the demand-supply dynamics, it's impossible to price that in today. And performance in 2022 has confirmed that thesis, that markets aren't pricing in the potential and the supply-demand dynamics that might unfold in the coming decades right now. Silver? Well, silver is interesting. So we talked about solar power. What's the one commodity in the world that's perhaps a better electrical conductor than copper? Well, that's silver. Now, silver is considered a precious metal, but draws more than half of its demand from industrial applications even today. But in the future, the biggest source of demand growth is going to be its energy transition applications, such as photovoltaic cells, solar power, electric vehicles. So in an electric vehicle, copper wires carry the electrical current, but each connection has silver coating to make the current efficient electrically. Hydrogen. So there's a lot of talk about green hydrogen as an exciting store of energy, as an exciting source of energy. What is green hydrogen? Green hydrogen is when you take water, you pass a renewable energy current through water, you separate H2 from the O. And what you have is clean hydrogen, and you call it green hydrogen. The end hydrogen is the same. It doesn't actually have the green color, but the process is clean. Compare that to how most of the hydrogen is produced today. Well, it's called gray hydrogen. Gray hydrogen is produced from gas, natural gas. So you take CH4, you take H2 out of CH4, and you're left with carbon dioxide. That's why we call it gray hydrogen. But green hydrogen is produced with the electrolysis of water. Once the hydrogen is produced, it is liquefied and put into a fuel cell. In that fuel cell, the hydrogen again reacts with oxygen and produces an electrical current. And that could power your car, it could power whatever you want. That's a fuel cell. Both of those processes, the production of hydrogen and then the ultimate use of hydrogen in a fuel cell, typically require a catalyst that is often made from platinum. So platinum, which in the past was being used in all sorts of things, but also internal combustion engine cars, is now going to find a new source of demand from the energy transition as well. And of course, platinum and silver are precious metals, so they are ultimately correlated with gold. And of course, gold is ultimately correlated with economic outcomes. So again, we can talk about the energy transition, but we have to be aware of what's happening with the economics today. So gold, of course, has a strong relationship with inflation, as shown historically. So at Wisdom Tree, what we did was we built a model trying to connect gold prices with economic outcomes. And we came up with 4 different variables to explain the price of gold at any point in time. Those 4 variables are the US dollar. There's a negative relationship, which was clearly on display last year. The dollar was appreciating, gold was facing headwinds. The reverse started to happen from around November time. Dollar started to pull back, and gold has found new support. CPI inflation, despite the headwinds last year from an appreciating dollar, of course, inflation was still on the rise, and that was facilitating gold's position. Treasury yields, again, a negative relationship, and of course, dollar and treasury yields, they go hand in hand. If the Fed is tightening policy, yields are going up, dollar is going up, and of course, that puts pressure on gold. If the Fed is becoming hawkish, then the opposite happens. And finally, investor sentiment. Speculative, there's a strong speculative market as well in gold futures, which impacts prices. So all of those, we forecast gold prices on a quarterly basis based on those variables, which ultimately determines the relationship with some of the other precious metals as well. But who are we? So at Wisdom Tree, we are an exchange-traded fund and exchange-traded product provider. We have a head office in the US, but a strong presence in Europe, and products across the asset class spectrum. Of course, today we were talking about commodities, and in Europe, commodities is our biggest business. So if you do notice that there's an outbreak of swine flu, and you suddenly realize or decide that investing in lean hogs is probably a very good idea, then chances are you will notice our product on the list there. But equally, if you believe in the energy transition story and you're not sure which commodities to pick to benefit from that long-term story, or how to weight them. Even if you know that copper is important, platinum is important, nickel is important, well, how do you weight them? What's the relative importance of one versus another? It's those sorts of questions that we look to answer for our investors. And we don't just think of ourselves as a product provider, we hope to be a service provider so that all of your research questions are also answered. And we would love to continue the conversation with you further. Thank you very much.
Thank you very much, Mubin. It's really impressive how you covered such a large scope of topics, from mined metals to precious mined commodities to precious metals. And yeah, well, the impact that the energy transition is having on the demand for metal, I'd say, is both fascinating and a bit scary. But thanks for telling us about it. Are there any questions to Mubin? If not, I'd like to invite you for a coffee break just now. We'll take 15 minutes. We are perfect on time. But please come back at 2:35. The next presentation is from Laura Cooper on the tactical asset allocation of ETFs. And this is not the one you'd like to miss. An intriguing topic. Laura Cooper from BlackRock will introduce us to tactical asset allocation with ETFs. Yesterday, we attended a couple of lectures and discussions on the use of ETFs for passive investing and other investment strategies. And we do understand that passive investing goes beyond ETFs, and also ETFs themselves are surely not limited to passive investing only. We do recognize that a well-executed ETF portfolio can ensure consistent growth and profitability regardless of the market cycle. But where is the market now? And what does it tell us from the macroeconomic perspective? We are fortunate enough to have Laura Cooper, a senior investment strategist at BlackRock, join us today. She has extensive experience in portfolio allocation, and we are eager to learn from her how the current macroeconomic outlook may transpose into our investment strategies. The floor is yours, Laura.
Hello, thank you so much, everybody, for having us here today, and apologies for getting in between the snacks. So actually, I arrived yesterday in Poland with my colleague, Nicole Chong, and it's both of our first times in Poland, and the weather was incredible, it was sunny, it was beautiful and warm. I'm like, what a lovely experience. So I woke up this morning somewhat disappointed, admittedly, but I guess it's like these markets, right? We have to be prepared for any kind of conditions, and you really have to kind of have your portfolio allocations in the same way, thinking about, how to brace for potential storms. And hopefully today we'll bring some of that market flavor to what has already been quite a robust discussion. So as was mentioned, I am coming from BlackRock. And I think it was quite interesting what Eva said in her presentation just about the increasing adoption of ETFs over recent years. And it's been interesting speaking with our own team here just how much our commitment is to the Polish market. We've been the first movers in this market, and as well, we're continuing to have very strong commitment. So turning to markets. So gauging by the amount of sleep that myself and my team had over the first quarter, certainly a challenging time for investors to navigate. Now, we really see this as what we call the end of the great moderation playing out. Okay, so what exactly do we mean by this? Well, BlackRock made a call last July that essentially declaring that we are entering a new macro regime, one that will be marked by high inflation and high macro volatility. So essentially, 4 decades of low volatility, low inflation has now come to an end. And so that does really require a different way of thinking about investing. And we call this the new investment playbook. So looking at what has happened in markets in the first quarter, we can see that this new regime is playing out in the sense that inflation is surprising to the upside. We have seen forecasters continue to revise their expectations for price growth higher, all at the same time that we are seeing economic growth become more challenged. So essentially, we do see central banks as really trying to fight this inflationary backdrop by aggressively tightening monetary policy to such an extent that we do expect we will see recessions in the US and Europe later this year. So how does one really prepare in this type of environment with tactical asset allocation? So earlier, maybe about a month or so ago, I do recall that our team was exceptionally busy, and certainly at BlackRock, in kind of helping our clients navigate what turned out to be quite significant banking turmoil. We had idiosyncratic events in Europe as well as in the US regional banks. And ultimately, this does add to our view that we are seeing a material tightening in financial conditions to such an extent, actually, that it probably alleviates some of the pressure on central banks to continue to raise their policy rates as aggressively as what we had expected earlier this year. So the fact that previously we did think the Fed, the ECB would raise their rates quite aggressively to create these downturns, now we expect the Fed is likely going to have one more rate hike and then pause as they assess the impact of their earlier rate hikes, notably because the banking stress is contributing to this tightening in financial conditions. So that is really kind of underpinning our view that a US recession is going to come through. So what are some trends that we're seeing come through on the back of this from investors? Well, probably the most notable has been the increase in money market funds. Now, this has largely been supported by deposit outflows from banks because you can really get higher yields in sitting in these cash-like exposures. So if you're an investor and you're looking at essentially all of this cash on the sidelines, what does it mean for allocation? So in our view, we do think that eventually, once we see key signs of kind of a positive economic backdrop emerging, more clarity coming from policymakers, that there's a lot of cash to be deployed on the sidelines. So that is clearly what we're watching for. It's just signs of some risk-on sentiment coming through. Now, in talks about, okay, so what are those key signposts? How can really gauge what investors are thinking? And I think a really interesting dynamic of the ETF landscape is that it provides a great proxy for broader investor sentiment. And there are quite a few interesting trends that are emerging when we look at ETF flows. So a couple do stand out that I wanted to highlight. So the first, I mentioned the banking turmoil that we saw in the US. A key trend that emerged from that is we saw investors allocate a record amount to ETF fixed income, notably rates, through that period in March. So ETFs are really providing that liquidity in times of market turmoil. Then another interesting trend in looking at broader investor positioning is we did actually see investors, yes, they were seeking those kind of defensive, safe haven type of plays, notably in US Treasuries, given the rate space, but they were actually seeking some kind of riskier allocations outside of the US. And the most prominent trend was actually their exposure to emerging markets. So we see in Q1, we actually had a record amount of inflows from global investors into the EM equity space. And as well, we did see that was largely underpinned by the China reopening, which has been mentioned before, just the robustness that is coming through on that front. Now, sectors are another way that we see clients leverage ETFs to try to get that tactical exposure. So we saw, for example, healthcare was more challenged, energy, but we are seeing technology, given that safe haven type of dynamics. Investors are really quite attractive still to that sector. So we had technology have the strongest inflows since about October of last year. So we are seeing, despite this exceptional market uncertainty, there are areas where we are continuing to see chasing the money in these key areas. So then, kind of taking stock of so far this year, if we think about, okay, well, that's kind of hindsight, how do we look about the market conditions and how to position going forward? So at BlackRock, we really break this down into three key themes. The first is around pricing the damage. So as I mentioned, we do expect that central banks have tightened monetary policy to such an extent that that will trigger recessions this year. But yet, when we look at equities, I mean, the S&P 500 is up 8% this year. The NASDAQ is up 15%. But yet, we have a recession looming. So clearly, there's this disconnect that we do think equities are not accurately pricing in that economic damage. Second, given central banks have raised rates to levels that we really haven't seen in a number of years, certainly in my career, really the fact that bonds are back because they are providing this quite attractive income given where yields are. And then finally, this whole macro regime change around the fact that we do think that we are living with a higher degree of inflation. So at BlackRock, we expect that inflation in the US, for example, will settle at levels well above those pre-pandemic levels. So it's about positioning for this. So how do we position in this uncertain macro environment, in this environment where central banks have raised rates, where we don't have great clarity on the growth path going forward, and certainly inflation continues to surprise? Well, we're underweight developed market equities. Now, this was a view that we took last July, and yes, it is still our tactical asset allocation, largely because we think that, as I mentioned, earnings are not accurately pricing in the damage yet to come. So looking at earnings estimates for 2023 for the S&P 500, it's about 0.7%. So that's still positive for the calendar year, despite the fact that we see a mild recession come through in the US. So if we look at previous downturns, we can see anywhere from profit recessions up to 30%, 10%. We're not expecting that degree of contraction, notably because the US economy is starting from a level of relative strength. But we do think that there is significant room for earnings downgrades in the latter half of the year. That keeps us quite cautious on the broader developed market equity space. So where do we have high conviction views? Where are we seeing investors put money, and where are we putting our own money in this uncertain environment? Well, as I mentioned, in Q1, we saw significant flows into emerging market equities. And we actually went overweight emerging market equities earlier this year. Now, that was largely underpinned by the China reopening. So the China reopening has come in faster than expected, sooner than expected. We do expect growth in China could have a 6% or even a 7% handle so far coming through this year. And so that is being captured in terms of our equity exposure. And we do think that is going to have spillover effects to the broader EM landscape as well. Now, it's not just the equity sleeve that we do like, in particular because, as the chart on the right shows, we can see that actually earnings are expected to be more upbeat in emerging markets. So they're not going to face the same headwinds as we think the developed markets will. Now, EM debt is something that we are starting to see investors allocate to as well. In fact, in April so far this year, we have seen local currency EM debt, along with some high yield, start to gain investor interest once again. Now, this is largely because central banks in emerging markets are much further along in their tightening cycles, and they're more likely to cut rates, provide a little bit of that capital uplift, rather than continue to keep policy rates restrictive. And then as well, if we think about kind of the big behemoth for emerging markets, the US dollar, we do think the US dollar peaked earlier this year, and one of our key convictions is that we are going to see dollar weakness through the end of the year. So then, how does this translate into our other asset allocation views? Well, as I mentioned, we're looking at the ways investors are positioning in flows in the sector space. So we do have a couple of key conviction areas that are more tactical in nature in terms of how we're seeing investors use ETFs in this space. So healthcare remains a key conviction area for us. Now, largely because we do think it's going to benefit from the short-term demand that's still coming through post-pandemic, but as well, if we think about the long-term demand. I mean, I know I'm getting older. I certainly feel it more these days. I know aging populations as a whole is really going to be a key challenge. We're going to demand more healthcare. So we think that that's key structural support for the sector. As well, technology. So technology has really tech stocks have really been the powerhouse of equity markets year to date, while we think they're going to be challenged more in the near term, we do think that the equities in the tech space still are an attractive tactical play if we look at the 12 to 18-month perspective, largely because these are still profitable secular growers, but it's really about taking a very granular approach to the tech space. So looking at the high-quality, pure tech plays, rather than just looking at the broad mega-cap spaces, where really the valuations perhaps aren't justified from a tactical perspective at this time. So then we talked about equities. I think really crucially what we're seeing come through, as we saw in the first quarter of fixed income ETFs really marking a record quarter, is the fact that bonds are back. And it's still ingrained in my brain when our head of fixed income in London paraded around the floor saying, bonds are back, bonds are back. So now everybody on the floor has a mug that says bonds are back, and it's pretty much our daily slogan. So it really just captures the change in environment that we have now for fixed income investors. So we do like short duration credit. That was pretty much a key conviction call across the street earlier this year. But we are still kind of having strong conviction in that. Probably the key area where we're an outlier in terms of consensus is we're actually underweight duration. So yes, we expect a US recession to come through, but we're not actually buying bonds at the longer end of the curve for a ballast. Well, why is this? Well, if we think about this time is different, the famous phrase and an excellent book, but ultimately, if we think about this is a higher inflation regime. We expect inflation in the US to settle around that 3% to 3.5% mark. So investors are likely going to demand that higher term premium to hold that longer end fixed income. And as well, I think markets may be misreading this current business cycle. So in contrast to previous business cycles where, okay, yes, we see a recession, what does the Fed do? They cut interest rates by about 300 basis points. That's not our view this time around. If anything, we think they're going to keep rates in restrictive territory through the end of the year. So we're not going to get that same dynamic that typically would support fixed income. But as I mentioned, you can get quite attractive income at the front end of the curve or even the belly end of the curve. And we are seeing quite a number of investors really take those tactical plays, leveraging ETFs in this type of space because of its liquidity properties. And then if we think about other areas of fixed income where we are seeing tactical opportunities, I mentioned short duration credit was a key area earlier this year. That trend is largely played out in our view. We are still seeing attractive opportunities in Europe, though, largely from a valuation perspective. So European investment grade at the front end, the short duration, we still think is quite attractive. If we look at what's implied by spreads from kind of the recessionary perspective, we think a recession in Europe is largely priced in. Now, in Europe, for the ECB, we expect they're going to actually continue to raise rates beyond the Fed. And given the fact that inflation continues to surprise to the upside, notably that core inflation, we do think that that actually tilts the risks in Europe towards that greater degree of tightening, but we think that's largely in the price. So you can get that high quality spreads without necessarily taking on the duration risk. So that is, again, an area where we are seeing quite tactical opportunities play out. Now, I mentioned inflation, new regime, and people often say, Laura, you're calling for this new inflation regime. Why all of a sudden, after central banks struggled to get inflation anywhere near their 2% targets or above for such a prolonged period of time, why really is this time different? And it largely comes down to three key themes. One, as I mentioned, aging demographics. A key trend that we saw from the pandemic is that a lot of workers essentially left the workforce. So we saw a structural shift in labor force participation rates. So we don't think that's going to resume, and if anything, we think that's going to keep pressure on wages. Then geopolitical fragmentation. we are thinking that now is the time where fragmentation is the highest that it's been since just after the Second World War. So the rewiring of supply chains, we think that's going to be inflationary as well. And then, as well discussed by Mobeen, just the commodity complex, this transition to net zero. He had a great chart with all of the kind of supply-demand dynamics and the shortages there. We think that's really the third pillar of what's going to drive this inflationary backdrop over time. So from an investment perspective, we don't think that medium-term inflation expectations are accurately pricing that risk in. So 10-year break-evens in the US, even 5-year swaps, pricing in about 2.5% long-term inflation. That's well below our expectation. So there is significant upside, we think, still in getting this type of inflation protection. And then finally, what was talked about quite extensively by Mobeen as well is around gold. And I think he talked about kind of the macro fundamentals of it and the underpinnings of why to be bullish on the commodity, which we largely agree with. I think an additional layer, though, we can provide is looking at the flow space. So what's been most interesting is that April so far, almost May, not quite, but so far in April, we have actually seen investors really renew their allocations to gold by the most that we've seen in more than a year. So it does suggest to us that, okay, are investors actually thinking that gold is going to have another renewed rally above 2,000? Maybe not. But what we are seeing is that investors are closing out, excuse me, their underweight positions that they've held through 2021 and 2022. And as well, it's really about taking on that safe haven type of exposure. So we saw that in terms of the rates profiles with US Treasuries, but it's clearly coming through in gold. And when we talk to clients, we say, what's kind of your thesis behind gold now? And it's really about taking on that diversification exposure. If we were to see a tail risk event coming from geopolitics or coming from inflation upside surprise or a steeper recession than perhaps markets are expecting in the US and Europe, they want to have this allocation to this real asset in gold. So that's really what's driving our view that you continue to need to have this type of exposure going forward. And then, so this is a very busy slide from those in the audience. I appreciate it's probably not the most user-friendly in this format, but it really does capture all of the different tactical asset allocation views that we do have. Now, the ones that I mentioned that are more recent are around our overweight to emerging markets. We do like inflation-linked bonds, and as well, EM local currency debt. So ETFs really provide this additional kind of a product for clients to be able to try to capture these different trends. So the key question I'm often asked is, okay, this is great, but what are the key guideposts you're watching in terms of actually changing these tactical asset allocation views? So I sit on our EMEA Tactical Asset Allocation Committee, along with Nicole Chong, my colleague in the back. And so some key guideposts that we're watching for now, one is around policy clarity. We really need to have some guidance, whether it's from the Fed or the European Central Bank, around when they expect to end their tightening cycles. As well, we're watching for signs of inflation. We had last week's final CPI prints from Europe. We had UK inflation that really strongly surprised to the upside. So we're yet to see meaningful signs of easing in this space, which does tilt the risk towards central banks having to tighten even further. So we really need to see some clarity from policymakers. Third is around sentiment and positioning. We are seeing US Treasury shorts, for example, in the 10-year, be exceptionally large. Are we seeing signs of a turnaround in terms of how investors are actually positioned? We're starting to see some signs of that in European equities, where we are seeing US buyers ease up their pace of European buying, which is an interesting trend because Europe has outperformed the US for a prolonged period of time. So the first sign of that kind of buying ebbing tends to be when we see US equity outperformance over Europe. So we're watching that sentiment and positioning quite closely. And then third, we're watching the economic data. I mean, much like central banks on a meeting-by-meeting basis, arguably our TAAs on a meeting-by-meeting basis, because we're watching for labor market deterioration, we're watching for softness in the US labor market in particular, because we think that will be a key guidepost to easing inflation going forward. But that's it from my perspective. Hopefully it's sunny. I leave tomorrow, but hopefully it's sunny for you on the weekend. But more than happy to take any questions if there are any. Or as well, Nicole Chong is my colleague if there's coffee break after for questions. Yes.
Hi, Krzysztof Stopnicki. I used to be Chief Investment Officer for AIG, MetLife, and ING. Now, one question. If we look at your macro analysis in the first part of your presentation, that was very logical. However, if I look at the tactical asset allocation, which is for 6 to 12 months, if we look back for the last 3 months, the markets, particularly the equity markets, have performed completely the other way around.
It's been a pain trade for us, yes.
Yeah. And on the fixed income side, it's more or less the same, the short-term versus long-term treasuries. So how would you explain that? Do you have a sort of off-record or on-record explanation what went wrong with this analysis or recommendations for asset allocation?
Yes. It's actually interesting because I wrote a piece in the Financial Times exactly covering this, in the sense that what we looked at from a positioning perspective, the rally that we saw before the banking crisis was actually largely a short squeeze in US equities. So investors were exceptionally short. We saw a couple of catalysts around that, notably from options expiries were quite robust. That really led to that. I think from now, though, since then, through the banking turmoil, it's largely been easing expectations coming through for the Fed. We had as much as 100 basis points of rate cuts priced in for the US in the back half of this year. And that, in turn, in our view, likely propelled the long duration proxy type stocks like tech to lead overall gains. So the fact that we have seen some of that price out, we think is not enough. We think that there's even more scope for about those 50 basis points of cuts in the year, by the year end, to be priced out even more. So we do think that's going to be, one, the key trend to watch for from an equity perspective, and as well earnings. So earnings so far this year, in this quarter, have been exceptionally robust, but from a beat perspective, largely because over the past 6 months, we've seen significant downgrades come through, so it's quite a low bar to beat. If we start to look at the key trends emerging this season around margin erosion, around deterioration in consumer demand, we think those are going to pick up more materially in Q2 and Q3, enough that investors will start to really challenge the valuations that we are seeing in equities right now. Happy to discuss this afterwards, because I'm curious for your thoughts as well, but yes.
Any other questions to Laura?
Hi, Jarosław Przybył, Alio Bank. I have a question regarding financial sector, because I had an impression they were overweighting financials. What do you think might be the impact of the exposure of US and European banks to commercial real estate, and also the outflow of deposits, or from deposits into money markets, particularly in the US? Do you think it might impact the earnings of the financial sector?
Yeah, this is a key question. In fact, we had our global investment strategy group team call this week, and that was kind of the key thing that our CIO focused on. So if we actually strip it down, looking at commercial real estate as a broader sector of total bank non-financial liabilities, it's actually only around 12 to 15%. So we don't think that it's going to be a material impact in the broader lending space. But so far, we expect that the tightening in lending conditions that could come on the back of that is equated to about 25 to 50 basis points of rate hikes. So at this point, we think it's going to be fairly contained, just already feeding through in the tighter financial conditions. But we don't think we're going to see material defaults within the space that would prompt kind of a broader credit crunch that we saw previously. And then the deposit outflow, I mean, it's something that we're monitoring quite closely. I think our US bank analysts are tracking that. I don't know, Nicole, maybe if you've been, no? Yeah, so if anything, what came through in US bank earnings last week was the fact that these large banks are the net beneficiaries of that. So the broader banking space, we think, is not going to be as impacted. Probably the key things we're watching for are, we expect greater regulation to come in, so higher capital ratios to come through in these banks. And we do expect more collapses of US small and potentially regional banks, but we think there's going to be that's going to be contained from a broader contagion perspective.
Anybody else? Thanks so much, Laura. Super interesting. We've already had quite a few presentations. Why not moving on to discussion time? And why don't we delve into some discussion about the current state of affairs and the general situation and trends in the passive investment markets around the world, which is the topic of our first discussion panel. Mateusz Krupa from mBank, who's one of today's conference organizers, will be moderating the conversation between representatives of our partners. I'm confident Mateusz will pose many thought-provoking questions, making for an informative and dynamic panel discussion. I will let you, Mateusz, introduce your speakers.
Hello, everyone. I'm Mateusz Krupa from mBank. I'm heading the equity strategy in our Department of Analysis, and I will host this panel. So our guests, you met already some of them. So Eva Miklaszova. From iShares, from Invesco. Mobin Tahir, you already met him. Wisdom Tree. Robert Sochacki from Beta Securities, our local representative. Coming already, yeah. Tomasz Paczka from X-Trackers DWS. And Bahram Sadijan from BlackRock.
Just a word of clarification, Robert will join us for next discussion about the condition of the Polish market.
Okay, so maybe one thing about this panel. Of course, we've got great speakers here who can speak long and interestingly. However, please, let's keep it short and dynamic. Let's start with some general questions about the overall landscape. So what most important trends you currently see in the global passive investment markets, and how do you see them reshaping the overall investment landscape? So maybe let's start with Eva.
So good afternoon again. Many thanks for the question. So maybe I will start with differentiating the passive investment landscape and ETFs, because I spoke today a lot about ETFs. And what we see is actually demand for ETFs, so a little bit less mutual funds. The investors are looking as well in the passive space and are moving from the index fund and passive funds into ETFs. And I have shown already a couple of charts at the beginning, so that the global ETF market is growing rapidly, and not only on the global scale, but as well in EMEA region. So this is one of the trends, is the other ETFs as a structure, as a product, as a new modern way how investors can replicate passively the indices, but not only, as well actively, semi-actively, and with quant approach regarding the ETF. So this I see as one huge trend which will continue in the next couple of years in the future. Then the second trend, and I will keep it brief, is ESG. Probably you heard about this already, so what this means. So this is something we observe in the market, and we see as well increased demand for ESG from the investors. And now I can mention, I'm talking about ETFs. I'm actually watching the flows of what's going on in the market and what's changing in the market. And for example, ESG is real trend, and year after year, the asset under management in ESG space is doubling in EMEA ETFs. And as well regarding the net new assets in the flows, then for example, 2022 was over 60% net new inflows into ESG ETFs, and the years before, as well, strong inflows in ESG ETFs. So we believe that this trend will continue. And asset managers are launching a lot of new ESG products on the market in ETF space. So we have now over 500 ESG ETFs in UCITS, under UCITS regulation. And then maybe I can mention the last one. What we observe is thematic investing. And this is not only in retail space, we see as well demand by fund of funds for some thematic, mainly in kind of these environmental topics like clean energy, hydrogen, wind, and so on. So thematic is maybe the last huge trend we can observe. And it was in the past like more in the mutual fund space, but now we see as well in ETF space that the asset under management in thematic ETFs is doubling and is growing, and so on. As well, number of the products is growing. So we have now over 160 thematic ETFs on the market. So that would be from our point of view, from Invesco, the three like huge main trends.
Perfect, thank you. We'll get back to this ESG stuff, but from a bit more, let's say, conservative point of view. Bahram, what would you say?
First of all, thank you very much for having us. I'm very excited to be here after 4 years really working hard getting all the ETFs registered here the first time in Poland. I started this journey in 2018, and getting the passive investment vehicle really registered in Poland was quite an interesting journey, and I'm so very delighted and excited to have now 180 funds the first time registered here in Poland. Talking about the investment trends or the trends in the ETF market, I think Eva said already quite a lot, but let me take a step back. I think I started quite a long time with BlackRock. I don't tell you when, because I think it's more than probably all the others here. But I had an amazing journey with BlackRock. But when I started with the iShares business, everything was about capital market weighted benchmarks. So we're moving away now the last 6, 7 years, and I think Wisdom Tree has got a lot of experience there as well as DBX Tracker and Invesco. So we've been moving away now from purely capital market weighted indexes or benchmarks, and are thinking more about having intelligent benchmarking and indexing. ESG is clearly one point or one factor here. This is quite a huge trend, and we're seeing this is emerging also here in Central Europe. Factors is something we're looking at. So we're trying to get the factors of those benchmarks where we believe that it will have an outperformance in a certain time period. So we're thinking about really how can we go more from capital market weighted benchmarks into intelligent benchmarking. And now we're also trying to, what we're seeing in the US and also in Europe, to have combination of these things, ESG and factors, for example, or combining ESG and thematics is something we're looking at. So I think the journey has just started. The next years, we're going to see a lot of developments there, a lot of, again, factors. We used to say smart beta. I like more the expression of intelligent benchmarking.
Perfect. Thank you very much. Next question would be, how can investors identify potential market inefficiencies and capitalize on them within a passive investment framework? Mobin?
So one important point to remember is that passive doesn't necessarily mean unintelligent. So you can still have a very sensible exposure to a certain market and do it in a smart way through a passive instrument. And that's why we're all here talking about passive investing, because we rate passive investing. One approach that we see has resonated with some of our clients is that idea of embedding expertise within a passive vehicle. So the idea being that if you want access, like I gave this example in my presentation about industrial metals, that you can have a passive exposure to the metals market, but embed certain expertise within that exposure, in that you determine which metals you want an exposure to, and how would you weight them appropriately. And these questions aren't easy to answer for us as an ETF provider, because we are investment people. We aren't experts in metals and mining and resources. So what we tend to do is we partner with external experts. Like in this case, a lot of the charts in my presentation, you might have noticed a footnote, Wood Mackenzie, and we rely on their forecasts because we aren't capable of producing similar projections ourselves. But what we can do is, by bringing in those expertise, offer a passive vehicle that's been built in a way that embeds those expertise. So that's really the key for me, that passive can have smartness embedded within it, and that can be an important consideration.
Perfect. Tomasz, what would you say?
Let me maybe take it from a different perspective, because utilizing inefficiencies through ETFs, I mean, just what are we? We are solution providers. So we all have a huge kind of amount of investment solutions on the platform that can be utilized by the investors. And it's kind of a very, I would say, democratic tool, because it's there for retail investors as well for institutional investors. It really depends on, how do I come up with an idea of investment? What is the appropriate investment for myself? And I would just rephrase it a little bit, because, we need to define the world where we are, Is it enough to invest into global equities right now? Like, challenge MSCI World Global Equities? Or do we really have to kind of rethink the world as we know it right now in terms of breaking it down from just right now, unipolar status, very US-centric, to possibly a multipolar status in the future? So if you could consider, the weight of China in MSCI World, would you know what it is right now? Yeah. At 0, because it's not a developed country. So we are kind of struggling right now with a few of definitions, what is the definition of, I would say, the world portfolio. And going into the future, China will get a much, much higher share of the wallet. Just consider right now, India was in all the publications, it's the most populous country in the world. And the weighting in all the capital market indices is actually not really there. Just if you take a look at it realistically. So how can you use this huge product range we have for investors? It's to thinking a little bit out of the box, really question what is the status quo and what are the possibilities the worlds are really heading to. And maybe let's take some markets like Canada, like Australia, very resource-driven. So there are a lot of a little bit different regions and markets to be at that could really make sense for the future.
Just let me add to that just one point. I think market inefficiency means that market participants don't have got the same amount of information at the same time. Normally, this is an absolute strong case for active fund managers. But how can you use it? Your question was, how can market inefficiencies be used by ETF investors? I think to Laura's point, you need to be very tactical. Yeah? You need to have the vehicles to understand at what time where you should be positioned and invested. And that's not quite easy for investors. I think it's important to get all possible tactical asset allocation support you could get from providers to understand your tactical positioning, to balance out inefficient markets. This is one point. The second point I would love to mention is in times of stress, especially in bond markets or corporate bond markets, we're seeing that the spreads are widening up. And we see that especially ETFs tend to help investors to balance out these inefficient markets or distressed markets. It had become a vehicle of choice for larger bond investors as well to invest in times of stress and be able to get the liquidity they need. So to your question about inefficiency in markets, one point is really purely about tactical asset allocation, which you can do in a very efficient way with ETFs. And the second factor is really about in times of stress and when we see the market, especially the bond market, is becoming inefficient, you can use ETFs here as a vehicle of choice.
Okay, so obviously we are touching some tactical views and also strategic ones, long-term and short-term. So maybe from the long-term perspective, we've got huge demographic shifts and such as aging population or the rise of the millennial investor, let's say. How does it affect passive investment and how do you see it play out? Maybe Eva.
Thank you very much for the question. So I think now I would maybe talk a little bit more about investors versus products, because now we discussed the products mainly. So I would split it, so aging of the population and millennials. So first, the aging of the population. As the population ages, so the people need to kind of create reserves for their retirements. So, and I think this is one very strong point, and mainly in the CE markets, not in every country is second pillar available, not in every country investors investing privately for their pensions. And I think this is changing slowly in the CE markets, that the investors and what we are doing here, all of us, is the education. So we try to educate not only in the passive space, ETF space, but as well on the mutual fund active market. So it's the education to explain our investors, retail investors mainly, that they should kind of prepare for the pension and kind of build up the capital and build up the assets. So we believe that it will be change the landscape, and investors will be even more and more aware about this need that they have to prepare for their pensions. And with the aging population, this will support the argument. The second point is millennials. So what we see mainly in the Western countries, but slowly as well in CE countries, is kind of online brokers, neo-brokers, and even classical banks are kind of offering new way of investing. So preparing kind of digital, offering possibility to invest via apps online and make it more like millennials, younger generation friendly. And I think this is the trend which will continue, and it definitely benefits ETFs because of the simplicity, of the cost efficiency and so on. But it's not exclusive for ETFs. It's just a way how the distributors are offering the investment products. And we see strong demands for neo-brokers in the Western European countries, and as well we see the movements of the classical banks in Slovakia, Czech Republic and so on to offer and to prepare new modern kind of distribution offering to their end clients.
Tomasz, would you add something to that?
To be honest, the markets we live right now are very much dominated by the big bank players on the market. And those are still limiting, I would say, the most efficient advisory of capital accumulation. So banks have their own interests, and ETF is not one of them, to be honest. So here we see a huge trend out of the society in the direction of how can I allocate my pensions, my investments, more efficient maybe than what is the status quo right now. And I think this is something we are in the middle of. So very exciting to see kind of this kind of changes and the impact also on the standard, old-fashioned, I would say, offering in the market. So there's a lot of going on. And to be honest, I don't think we are prepared for the millennials. I mean, yes, for millennials, just Generation Z and the kind of the young generation coming up, because we do not communicate to this kind of group. I don't think at all, to be honest. That's going to be challenging for us.
Interesting. Bahram, next question for you. So, of course, this is, let's say, for the street, let's say, for me at least, the outbreak of the generative artificial intelligence is impressive, and it will impact many different things, and of course investing. So how do you see that development of deep learning, especially how do you see that impact on investing and passive investing?
I think we've been seeing an amazing journey the last 2-3 years when it comes to technology. And technology is becoming a very important factor for investors, but also for providers and asset managers. Artificial intelligence is one point of these, and there we're just at the beginning. We're going to see definitely a few of these developments. But if I combine technology also with asset management or with investing, I think investment decisions in the future will be also based on technology. Technology can deliver you data, can deliver you some further insights. The possibility to access information is becoming much faster. And it's for all kind of investment decisions, it's going to be a very important factor. When we think about fund management per se and artificial intelligence and technology, big data is something, of course, a lot of asset managers and investors are looking at to really get information or gather information here. They need to understand where are the future trends, like my colleagues just mentioned. So the mega trends is something which has been based on big data, where we got a lot of information, what will be the future trends and what will be the future developments. Technology had been supporting that quite a lot. And I do believe that within the next years, we're going to see further developments there. Also, in terms of indexing, and I'm sure my colleagues think the same, we're going to use technology, name it artificial intelligence or technology, we're going to use it to be more efficient in building better benchmarks, but also being more efficient in managing passive vehicles and ETFs. So it can help us really to save time, cost, and get more efficient there.
Impressive. Tomasz, you would like to add something?
I think the topic is it's already happening. That's something we are in the middle of the development. Because, I mean, AI, we have to define what do we understand under AI. I mean, ChatGPT is impressive, but it's still kind of a game tool, what to do with that, just what's going to be the real impact on our lives, on the jobs. But AI, there are so many AI utilizations already right now being used in the market, and we are already using AI in our ETFs. So the index methodology, like putting up the index, and also what colleagues have been mentioning, yes, it's about kind of an intelligent way of composing the index for a different thematic investing or idea. And for example, the thematics, it's the best example. For example, our AI and big data ETF is using crawlers, self-learning crawlers, that are analyzing all the available patent data. And I cannot myself analyze 3 million patents and allocate those to the companies. So that's what AI is doing for us and giving us kind of this big data or this data edge on how to compose the ETF. So that's something we don't have to wait for, that's already happening. This vision of having AI trading by itself, I think that's something we are going to wait for a much longer time.
Thank you. We are getting to the next question. I promised we will touch this ESG themes, and I guess all of us here wouldn't say normally a bad word on that. Everyone loves ESG and money is pouring into it and so on. However, there are people that don't think that way. So let me quote Professor Aswat Damodaran's view that the ESG is the most oversold and overhyped concept in the history of business. And what would be your response to Professor Damodaran? Mobin, would you like to take the question?
So I'd say if you are using ESG as a tool for virtue signaling or promising a certain performance, then you've got it wrong. But if you're using ESG as a tool to support the conversation of how can capital make a positive impact on the world, then you can't have enough of that conversation. Take, for example, plastic waste. There are 14 million tons of plastic going into the oceans worldwide every year. Now, a question about can we structure societies, particularly emerging markets where most of this plastic waste is coming from, can we structure societies in a way that people are incentivized to put their plastic waste towards recycling, there's sufficient logistics, and then there are companies that can actually make the recycling happen. All of this conversation is conversation that needs to happen, and this, progress needs to be made to avoid 14 million tons of plastic going into the oceans. And we are a long way away from eliminating that problem. So you can take ESG as a tick box exercise, or you can use ESG as a tool to determine where can capital actually make the most impact on changing the world. And as representatives of the investment industry, we control a huge amount of capital, and that capital has huge potential in making those contributions. So it shouldn't just be a tick box exercise. The ESG conversation needs to go further and see how your investments are actually being deployed and what change are they actually enacting.
Perfect. Tomasz, I think your presentation will be next on impact investing, so I guess you will cover it. So maybe Eva would like to add something here?
Maybe I would maybe drift a little bit from the question, if I may. And in the last couple of years, as we see it, I think, first of all, to make clear, Invesco thinks that ESG is important, and we are launching new ESG products on the mutual fund side and on the ETF side. But let's talk about performance, maybe, because that was something which a lot of investors kind of make nervous in 2022. And 2021 was perfect, so everybody was happy with the ESG ETFs or ESG funds. But 2022 surprised a lot of institutional, retail, whatever investors. And between us, like asset managers, we kind of, as it was already described, look at, okay, how we can provide most green possible ETF product on the market as possible. So to kind of discuss with MSCI providers, okay, let's add here maybe PAB, let's add here more ESG score, look maybe on the social, don't forget governance, it's not just about E, and have this discussion to provide with the best ESG score, with the lowest carbon intensity ETF on the market, and then another provider try to improve the index and work again with MSCI to provide on the market something even better and so on. And that was kind of, I would say, run for the best ESG structure, ESG kind of products, ESG indices. What we see now after this kind of wake-up call in 2022 at Invesco, that a lot of, I just don't want to call it like that, but a lot of indices are not very smart constructed. And it was already touched on today on the smart, intelligent construction and factors as well been mentioned here in this panel. And what we are looking at is to kind of look more from the semi-active, maybe quant approach to construct these kind of ESG products with very high ESG standards, but construct it smartly. So let's look at, okay, what is my factor drift actually when you are constructing ESG ETF or ESG mutual fund? And usually when you look at the very green indices, you see, oh well, so of course, obviously my value factor is significantly underweight. And it doesn't mean that it has to be like that, because of course you exclude controversial companies, energy, and so on and so on. But there are many and plenty as well green value companies on the market, and you can, by the smart portfolio construction, kind of move more to portfolio factor neutrality and a little bit smoothen the kind of the differences in the performance of the very dark green ESG indices and non-ESG benchmarks. And you can do this on the equity side, of course, but as well on the fixed income side, it is possible to look at the construction and to see that your spreads are in the same level as non-ESG benchmarks, that your credit quality is similar, your duration is similar, and you can still have pretty good ESG score.
Perfect, thank you. And now let me ask you some set of questions that will be delivered to all our dear panelists. So how international institutions like yourself, ETF providers, see Poland versus the rest of Europe in terms of index adoption and this passive revolution? Bahram, would you start, please?
Well, that's a difficult one, to be honest. I mentioned already that I'm covering Poland now for quite a long time, and I remember like 7-8 years ago, the average management fees here had been for active funds had been 2, 3, 4%. So that has come down. This has changed, and I'm very happy to see that investors, also retail investors, are more looking now on different factors like price, efficiency, transparency, etc. All the things which have been already mentioned by my colleagues here. I do believe that the percentage of passive vehicles and ETFs in Polish portfolios are still underweight. So now I expect these to rise, and we are servicing institutional investors, pension funds, asset managers, insurance companies, wealth managers, and I do believe this is going to the percentage of the usage of ETFs are definitely going to rise. Let me also mention that an observation we're making now the last 5-6 years in Western Europe is digital investing, so Digi and ETFs. And I expect to see these kind of developments here in Poland as well. And ETF saving plans is something which is extremely important. So the numbers in UK, in Germany, but also in Austria, where investors are using ETFs to build on wealth or to save for retirement is jumping up. And I do believe that we're going to see the same development here in Poland as well. I don't need to mention the advantages of having an ETF saving plan. Costs, cost average effects, etc. All these kind of things move people really from traditional investing more into ETF investing and ETF saving plans.
Thank you. Tomasz?
In the past, we had a lot of discussions with our clients, active versus passive. What's the advantage for passive? What's the advantage for active? There have been huge discussions. To be honest, we are quite over that. That has been solved. There is active, there is passive. Both being used, Both have very good arguments for that. The ETF utilization in the market, as Bahram already said right now, is very growing in this retail segment. So really people using these products for personal kind of investments and savings. The biggest one we see in the UK. There is no kickback, there is no kind of retrocession being paid, so huge utilization of ETFs. Now, Germany is the next one, picking up crazily. So the flows into ETFs there are getting really, really significant. Austria is maybe minimum 5 years behind Germany, even more. And Poland, I would say maybe 10. Unfortunately, this historical legacy of having very, I would say, strong active distribution, it's not easy maybe to break up that fast. So we still need kind of this, I would say, change in way of thinking, in communication, in education, happening on the floor here to be able to really generate some change here. But it's happening. In Poland, it's already happening. There are big players like mBank sitting there, really pushing this change forward. Still is gonna need some time, but I think the direction is the momentum is the correct one.
Nobin?
It's funny, in a conversation earlier, it came up that there's a lot of appetite in Poland for short and leverage products. So clearly, there's an appetite for expressing tactical views, both on the leveraged long side and short side. And from our perspective, that was interesting to learn, because last year, without a question, it was a challenging year in investing markets. But as a business for WisdomTree, one of our most successful ranges was the short and leverage range. So people were expressing tactical views for short-term tactical bets, even at times when otherwise it was a difficult market backdrop. So clearly, Polish investor base had something to do with that business performance. But beyond that, of course, we are here, and we want to know more about the challenges that are facing investors in this market. And of course, my colleague Timo Storz is sitting right there, and we would love to hear more from all of you.
Perfect. Ivan?
Thank you. So not to repeat what has been said already, to be brief, so we believe we are at the beginning of the journey. But the question is, what is our mission here? All of us. We are not here to compete to each other. We are here together as well with local players, local distributors, to educate the market in Poland, to educate the clients, to help to develop the market. That, as we discussed during this demographic question, that the clients and investors are able then to build up their capital for their retirement and so on. So I think this is our mission. This is our aim. What we are doing here as well today is to educate on, like, briefly topics. Every kind of ESG or thematics or smart portfolio construction, intelligent indexing, tactical asset allocation. So I think this is the most important of our activities in the market, and we believe we will help the end clients. We will kind of do our work well here, and we will all as an industry benefit from that.
Thank you. And the last but not least question from my side, and I guess it might be the most interesting one for many of you here. So you mentioned that Polish people like these tactical trades. So I would like to ask you to provide your, let's say, ideas, one for the long term and one for, say, from the tactical point of view that you currently have in your mind that might be, you know, a good idea, or you personally follow and think this is the big thing. Of course, BlackRock mentioned this tactical short-term government bonds and inflation-linked. Mobin, you mentioned commodity super cycle for the long term on the other hand, but many metals there, maybe you like one of them the most. Or maybe your favorite is totally different from these commodities. So please, maybe let's start with Evan now.
So let's start then with the long term. For retail investor, I would say that the basic rules of the portfolio constructions are the most important for the long term, that the portfolio is very well diversified, regionally regarding as well among sectors, that the period of the investment horizon is that the portfolio is really like built up concretely for every single client. So this is number one, important. And it doesn't matter if you put it together from mutual funds or from ETFs. We believe that, as I mentioned at the beginning, that there are a couple of longer-term trends which will be there and will stay here as a ESG, so it will not disappear. So we believe that there should be part of the portfolio as well in these kind of products, some thematics, and as well to look at how investors can achieve some, by smart portfolio construction, extra performance, or with quant, maybe some smart indexing and so on. On the short term, yeah, I mean, it's ETF, I come from fundamental portfolio management, so I've been doing 10 years of selling mutual funds. So, and I see the huge difference between the mutual funds and ETFs are really dynamic. And mutual funds are for a lot of investors like, okay, I select a global mutual fund or, I don't know, American mutual funds and I stick to it and it's fine. Maybe some institutional players do some reallocations. When I'm working in this ETF world now, so it's so tactical. I mean, really, the investors every single week is different. And I am looking at the flows. And at the beginning of the year, we've been mentioning our, like, okay, European equities, maybe it's good decisions for the clients, so we saw a lot of flows there. Then recently we saw, okay, European corporate bonds being in demand of investors. Now we are seeing a demand for US treasuries. They are again hot topic for the clients. Then as well with commodities, we saw demand maybe beginning of 2022 when there was kind of this shock in the market in gold products and so on. So it's really tactical and it's not predictable, but you can still kind of like swim with the market. When you see the flows, when you see what investors doing, then you can as well.
Okay, so tactically, here and now, what would be your bet?
That's a good question. I would say definitely, depending on what the central banks will do. So when we actually move quicker through the cycle and the inflation as expected as our macroeconomics and tactical yesterday mentioned projection, then we expect we can then benefit from the longer duration asset classes in the equity space. So when we are peaking the inflation quicker, so in US we'll be then quicker out of the troubles. But when we are not so quick, then maybe the short duration asset classes, as mentioned today, in the fixed income side could be one of the choice of the investors. And then on the other hand, US treasuries, we see the demand now in the US treasuries, so could be as well one of the options. And we should not forget that the longer duration US treasuries is like very good place to hide in case there is some slowdown in the economy.
Okay, thank you. Mobin, one long-term strategic idea and one tactical short-term idea, please.
Tactical short-term would be carbon, because completely uncorrelated with any prospect of recession. It's going to be driven by regulatory developments in those specific markets. So no matter what happens on recession and what the Fed is doing.
Sorry, you mean carbon allowances?
Carbon allowances. So there are different carbon markets in the world, but of course in Europe, the biggest one is European Union carbon emission allowances, which is the most liquid market. So tactical would be that, and the long run would be industrial metals from the energy transition, but of course they could potentially have some short-term headwinds if recession hits.
Lithium.
What's that?
Lithium from those metals.
Within those, yeah, lithium is one of them, but copper is biggest. I mean, you could pick lots of them, but any of them would work.
Perfect, thank you. Tomasz?
I'm not going to give you two. You know, I mean, just in the financial industry, we make things so complicated, to be honest. Let's keep it simple. I mean, just what is it all about? Let's grab some equities, put it on your portfolio, run a savings plan, and enjoy in 20 years. You will. And if it's now Europe, if it's US, I mean, come on, guys, we are speaking about like 2 months. So I mean, I can't give you, I don't know where in 2 months the markets are going to be, but I know that equities has validation, it has dividends, it has income, cost average effect, super powerful. Let's go that way. And on the side, I mean, let's play. Let's keep this global topic in mind. Let's see where the markets will change. This global, decentrical approach. Let's embrace it. Let's see where it's heading us. That's my point.
Okay. Of course, no one knows what will happen with the market within 2 months, to be honest. But still, wouldn't you be eager to provide any, ideas? It's
To be honest,
simple. You want
I
it
have
simple.
I
it's
have a
simple.
great idea. Let's invest cash. Why?
Invest in cash right now. Okay.
Why?
So
Because
you
the
are-
banks do not give
you
you
are
the interest
defensive.
rate.
So we are defensive, tactically, and for the long term.
Look, just right now, one of the biggest interests we see from the market is cash alternatives. Why? Because the money at the bank, you lose out a lot. There is inflation. You don't get any interest. So the banks do not pass kind of these interest rate levels we see on the financial markets. Why don't you buy a cash alternative? You buy kind of Euro cash overnight. You just get over 3%, risk-free. Why not?
Okay, thank you. Bahram?
Let me say that I'm not allowed to give any investment advice because
Of course,
my
it is not.
compliance officer will kill me, and I know it is also streamed to retail investors. But I would split the question into 2 parts. One, long term for retail and end investors. What can you do there? And what can you do here if you're a professional investor? I think long term, you should think about a multi-asset ETF solution. Try to find a product that is doing the allocation right. Try to find a product that is not too expensive. There are also some multi-asset ETF products outside there, and you cannot go wrong with that. If you buy this on a regular basis, again, having a saving plan or also one-time investment, you cannot go wrong with that. And I think, to Thomas' point, putting cash to work, either in cash products or having your cash on saving accounts, putting it to work, this definitely makes sense. On the second part, the tactical traits you want to hear now, I think Laura Cooper is doing a much better job than I would do. And there's so much guidance outside there. If you just read the research papers, you get much better tactical views. Just from my point of view, be nimble when it comes here to equity allocations.
Okay, so that's it. Maybe you've got some questions from the audience. We've got one.
Hello, Artur Wiśniewski, Stockbroker PL. I have a question about the ETF distribution model in area of investment advisory, so banks more or less, because there was a problem in Poland that this model wasn't too healthy because clients don't pay the bank directly and they offer those products which are best for the bank, I mean the upfront fees. But I can see that it's changing because some banks are trying to introduce investment advisory fee, which depends on the amount of money which client brings to the bank, which seems to be healthy. But I was quite surprised that the bank still offers the same products. I mean, the client is now charged twice because it's the investment advisory fee and also the upfront fees. So I was really optimistic about this investment advisory fees being introduced, but now I'm negatively surprised and I'm quite pessimistic. So do you have any idea what to do to solve this problem, to bring those relations between bank and the client to a healthy point?
Anyone?
Maybe I take that. I think we're seeing an evolution in the wealth business. So just like you mentioned, the development in fee-based advisory is something we're seeing in Central Europe. RDR has been something which has been already mentioned. So the ban of retrocessions for products is something which has been pushing really investors also into passive vehicles. Of course, you have to talk with the banks who are developing these wealth systems. But to my point of view, I do believe we're going to see a shift more into fee-based advisory and more usage of ETFs. And of course, it needs to be something from the point of view of the bank or of the provider that is not gonna take away your revenue streams. It has to balance it out. So a healthy mix of, let's say, in-house products from a point of view of a bank. So positioning your own products and external providers or ETFs to bring down the costs would be something which would make sense from my point of view. But we also see in Germany banks who are offering ETF-only portfolios, of course, as in addition to other solutions they have in-house. But this is a development we're seeing now in Germany and UK, and probably going to take a little bit longer in other countries.
But it's happening. I mean, European Union has this kind of push towards these retrocession bans, even though it is a huge headwind. But let's see where it ends. I mean, there are kind of also people knowing about this issue and addressing this.
Perfect. Maybe one last question from Mr. Robert Sochacki.
Thank you. We are all guests of Warsaw Stock Exchange here, and I was wondering, where do you see, because the trading of ETFs is being concentrated in the major exchanges, trading hubs, and where do you see the place of kind of regional exchanges? Not only Warsaw, but there are many such exchanges in Europe. Where do you see the place for these exchanges in this passive path of passive growth, growth of the passive products?
I'd say it's only hopefully going to go in one direction, which is the right direction. And that's primarily the purpose of us being here, to hear from you in terms of where the demand is, what your problems are, and the obstacles along that way. And hopefully we can make progress in the right direction.
But to be honest, I mean, the local exchanges is the gate to your market. And these markets are going to get stronger and more important in the future. So the local exchanges is kind of really the place where also Poland and other countries can grow. The combination with the ETF is also an important one. I mean, maybe not to list the ETFs themselves, because it doesn't really make sense from the product perspective, but really having healthy markets, liquid markets, is great for the ETFs, because the sourcing of the underlying asset is much more efficient, and we all can participate or kind of, be efficient with that.
Okay, so that's it. So thank you very much, Eva, Mowin, Tomasz, Bahram. It was as dynamic as I expected, so thank you for that. And that's it. Thank you.
Thank you.
Thanks very much for a real dynamic and super interesting discussion. And thanks to Mateusz for a skillful moderation of the panel. We are now ready to have another coffee break, and we are on time. So please take 20 minutes and be back at 4:25. Thank you. we still have an exciting presentation and a panel discussion ahead of us. So you were talking that passive investment is getting traction and ETFs are getting traction in Poland, but impact investing is getting traction at an increasing rate. More and more investors are seeking to invest in accordance with their own values and to ensure that their investments generate positive, measurable social and economic impact, in addition to the financial returns. However, what does impact investing mean in practice? And how does it correspond with passive investment instruments and strategies? We are very happy to have Thomas Paska, Head of X-Trackers Sales for Austria and Central Eastern Europe, who will present some concrete data to help us understand this better and to learn how the impact investing concept is advancing into the public markets. I'm eagerly anticipating your presentation, Thomas. The floor is yours.
Thank you very much. All right. Are you refreshed? Everybody up and running? At least a little bit. I will try to make care that you don't fall asleep afterwards. So after the sweets, and see how can I give you a little bit more details on this, I would say, very complicated topic. But before I jump in, first of all, big shout out to the Warsaw Stock Exchange team. Thank you very much for putting this conference together. And I love this stage. It's really nice what you have put up together here. I enjoyed time in Warsaw very much, but in German, there's a beautiful word. It's called Pechvogel. I have no idea how to say it in English. You know, I'm not so lucky with the weather too. I'm quite often here, but to be honest, I had always a bad weather here. It's unbelievable. Really, every time. Even it's snowing, it's raining, or it's a crazy wind. I have no idea why. I think it's my personal destiny, but I have to change that. I have to come much more often to you here. Yeah, that's the best example. You know, I joined to today, and it's already raining again. Probably. I take it personally. ESG is a huge topic. And in the discussion we had this topic, kind of, what is ESG? To define what exactly do we want to reach with that is not so easy to do. And impact investing is even more special. And I've been asked already before, I mean, what is this impact investing? What does it really mean? It's environment. Yes, it is. But there are much more shades to this topic we can do and we can reach over investments than only E, environment. But let me go a bit more into detail. And today, I'm not going to be speaking about myself, about our company, how great we are. We are great. I will be speaking about what the investors do. What investors try to reach with that. Because ESG is kind of I would say, not a very well-defined topic. We have been working with investors on this for the last few years. We've been asking investors on all the separate E, S, and G topics, how do they behave, how does it impact their life, how does it impact their investment decisions. So 2021, 2019, it was all about ESG. Last year, we went into net zero and impact investing. So these two topics, we have spent some time in speaking to investors who are the largest movers, who have some experience in this topic, who are doing already some investments here. So we've been speaking to the 50 biggest pension funds in the world with approximately 3.3 trillion US dollar assets under management. So who are the big movers here? First, we need to understand what their task and target is. What do we want to reach with that? And we need to define a short structure for understanding. That is, this investment has to be made intentionally, so intentionality, on purpose. So I want to do this trade. You want to reach additionality, so you want to reach kind of this positive outcome that is being delivered due to your investment that otherwise would not have happened. Okay? Additionality. Measurability is something we want to know, what did we reach with this investment? How can we report on whatever good we are doing in the market? Okay, so this reporting part is also very, very important. And finally, it's positive financial outcome. So we are not for free here. So this topic, kind of this antagony to the philanthropist approach we have seen in the past, really doing something good out of my will, but not expecting returns out of that. That's not something we are playing right now, and what pension funds are doing. That's not their business. We have been speaking to clients or to pension funds from all different regions and from all very, very different segments. So DB plans, defined benefit, DC, defined contribution plans, hybrid plans, public plans, private plans. To get a picture of the market, how to define this impact story and how to understand the clients, what they are doing. Because in the end, we are just solution providers. We are providing solutions for clients, investing into ideas, into regions, into sectors, and understanding clients for us is kind of the utmost important topic here. But let's see, what is the investment appetite, or kind of what are the drivers for the pension funds to go into the impact investing? It's regulation. Regulation is driving a lot of momentum. For example, the Net Zero Initiative. Net Zero Initiative has been very strong in really pulling clients into discussions, into decisions, how to reach a given goal of this Net Zero 2050 decarbonization. It's been approached by governments and corporations, and in the meantime, above 80% of carbon entities are covered through this initiative. That means a substantial part of the market is already in discussions on these topics. United Nations is also estimating that we need 5 to 7 trillion US dollar annual investments to be able to reach the 17 UN SDG goals. That's really a lot of investments needed there. And I have really bad message here. Today, Austria was publishing numbers, and we are just 20 years behind the plan. Just 20 years. Instead of 2030, we are in 2050, when the game is going to be kind of really already decided. So a lot has to happen in order to move the things forward here. So the governments also are being forced. But, for example, UNPRI has impacted 800 new laws being implemented by the governments and 550 laws being revised. And also thematic investing is coming to the forefront. So thematic investing is something that the pension funds are really interested in, and where a lot of this, I would say, let's come to it a little bit later. Let's look at the public markets. Here's one of the points: enhanced engagement activities. That is getting very strong meaning. The pension plans understand themselves as universal owners. So they own assets for a long term and want to keep these assets. And they see themselves as agents of change. So they understand themselves as, what can I reach with my investment, and how can I deliver this goal for my pensioners, for my trustees? And second really big development here is, I think we can't see it here, it's actually the movement of companies from laggards to climate leaders. This change being happening, and one of the initiatives most important behind this is the SBTI, so Science-Based Targets Initiative. That is really developing with the companies a target how to reach this decarbonization rates, or kind of to keep the Earth warming in the limits. So this SBTI has a huge backlog in company, I would say, plans how to reach these goals, even to be able to publish it. So a lot of the companies are really pushing on this background, publishing these science-based targets, how to keep this European transition guidelines and targets really alive. Adoption of the investing is actually something really, we see a lot of potential there. So for the active portfolio, it's a little bit higher. It's approximately 30% where impact investing is already implemented. On the passive side, it's just 4% who are already fully embedded, and 18 are in the implementation phase. So here, it's a new phenomenon, small numbers, but positive progress. This one is interesting. Let's take a look on the themes and on the outcomes. What are the themes these pension funds are looking at? What do they want to invest? And if we look at it, affordable and green energy, biodiversity, reduced inequalities, social housing, quality education. It's not only E, it's not only environment. And those investment themes are very much impacted or aligned with the UN SDGs. UN SDGs, however, have been made for governments, for legal entities, okay, for the lawmaking part of the legislation. But it's delivering a guidance, kind of a framework to work with, and the companies can kind of embody those investments and make them a priority. There's one point, governance, which is a very interesting one because it's a little bit outside of this investment topic, but governance makes a huge, I would say, importance, delivering to the clients a framework they can work with. That's why it has such a high importance from this outcome perspective. Yeah, outcome, where are we? 44 positive, 22 negative. To be honest, the study has been conducted last year. So we had 2022, impact from Ukraine war. I think those numbers have gotten even better, but it's a long-term game. And pension funds are not only for 1 year here, so the outcomes are more long-term driven here. Which markets do we look at? Private equity, bonds, private debt, equities, infrastructure, real estate. And you can see on this dark balcony, every position is kind of growing in importance over the next 3 years. So we will see much bigger interest in increasing kind of the capital allocations in one of these asset classes that are, you know, by definition in the impact space. But how do we do that? How do we implement something like that? You know, and we in finance, as I mentioned before, we tend to make stuff so complicated. And that's something we need to change. Also ESG, what is ESG? There are so many different solutions on ESG, what we can put on the table. I mean, I can speak the next 2 hours only about our index methodologies for ETFs. And in the end, maybe nobody will exactly understand what I want to say. So here we need to get much more concrete on what do we want to deliver to the clients and what do the clients really need. First of all, customized funds. This section is an interesting one because it's the EU climate transition benchmark and Paris-aligned benchmarks. This is going to play a huge role going forward. So the PAB, CTB, so climate transition, Paris-aligned benchmarks. There is a very good reason for that. It's benchmarking. These products are not benchmarked against, for example, MSCI World. They are benchmarked against the net zero initiative, so against delivering the net zero path. It's a regulatory push, so it's nothing we are kind of coming up. So this segment you see is going to double over the next 3 years. Thematic funds. Thematic funds are a real interest in the market. So it's more this UN SDG-driven investing, green social bonds. So this direction is already also available, and we are working on a lot of solutions, really making the UN SDG also investables as a separate product solutions. And in the end, we see the core funds, they're on the below. So core funds, they see the lowest increase compared to the other two groups. So here, ESG is already implemented, and these clients are more looking into implementing climate-related, I would say, way of thinking instead of this pure ESG. And why is that the case? I will jump back to this slide to mention clean water and sanitation. Super important. We had it also in this environment piece of the study. It's getting diluted under environment. So in ESG, this clean water and sanitation, you are losing a little bit the touch to this investment goal. Or for example, labor rights. That was also one of the topics we have identified as very crucial for the future, but still, it's in the social pillar getting somehow diluted. And this is something we need to work out and make it concrete and investable from that perspective. Coming back to the slide, this is very, let's put it that way. Thematic investing means tracking error. Okay, you need to take some risk to go into this market. Are the investors willing to take this risk? Not right now. We are in the phase of learning, of experiencing this kind of investments, and 54% are willing to take a tracking error between 0.1 and 0.9%, so not even 1% tracking error. And this is something that is going to change. The more experienced investors get with these solutions, with these investments, with the feeling for tracking error or for the underlying asset, also the tracking error acceptance will grow. So we will see kind of movement more into, tracking error coming maybe to 3 to 5% direction. Why we do that? There is one very important point, actually from the first page, I would like to mention, because it's very important. In the end, also the pension funds have fiduciary duties. Duties against their pensioners for financial security in the future, but also not giving them only the security of receiving financial security when going into retirement age, but also giving them a world they can still live in. And that's the idea why this whole, I would say, trend is evolving very strongly. And among those biggest investors, it's something they really have on the table on a daily basis. And coming to the last one, which is also a very important one, and impacts actually all of us. What is the right selection of the partner? And on this slide, there is one point. A few years ago, it wouldn't be at all there. It didn't exist. That's the first one. Stewardship and proxy voting. This topic has such a big importance for the investors because they want to speak to the companies. They want to deliver a message. They want to have this exchange. And we had this example of a Swedish pension fund who really they're looking for the place at the table. They want to understand the strategy of the company, And leveraging on this understanding, leveraging on this information to kind of push it also forward. So really having this stewardship in place for a company is one of the biggest and important points, at least for the investors going forward. Reporting capabilities, being able to report on what are we reaching with our investments. And important one, which was leading the pack before, are fees. Fees and charges reflecting value for money. And that has changed. Right now, it's not all about money, not about super lowest fees. It's more about the value you are able to deliver for the client. And this is something we need to bear in mind as investors. What is the idea behind investing? We are speaking about ESG, but what do we generate with these investments? What is the target? What's the task? And we can start kind of making this decision by a very simple details. And that is for myself, take a look on your daily life. How are these things influencing my life? And they are, unfortunately. And they are strongly influencing us. So my super small house I have in Wiener Neustadt in Austria, the water dropped 30 meters below the normal standard. So we are losing water in our region. That has never been the case. And this kind of signs are getting more and more, we are getting comforted with. And I think this clear communication in the financial industry is something we need to work on, really to understand how can we give our clients the right solutions on hand, really to make the change also happen. From my perspective, thank you very much for your attention. I hope you are still awake and open for questions. Don't be shy.
Oh, there is a question from behind.
Hi, good afternoon, Jan Rakel. Thank you very much, Thomas, for a wonderful presentation. Just one question, because at the very beginning you showed us that roughly 2/3 of the respondents were defined benefit plans. 1/3 was, let's say, DC plans. Would you think that if we were to target DC only, the respondents would be slightly more would be less risk averse in the responses because of, let's say, the DB plans having the risk of being underfunded, having the general concept of de-risking of DB plans. So maybe that's also some way to approach this information, that maybe the DC plans would actually be more willing to take the impact investing as an option for their portfolios. Thank you.
Very good question. Thank you very much. The situation is actually completely opposite one. The DB plans are the ones who really have experience, who really are investing, and who really want to drive this topic forward. So DB is actually the one who's doing the most. And DC is maybe catching up, but not yet there where we should be. And it has also a regulatory background. Also in Eastern Europe, just the regulation is so strict that even few pension funds can't even do this kind of stuff. So they are, by definition, not allowed. And there is also a kind of big push necessary from the regulator side that the investors can actually do something with their capital. And maybe just to put it in numbers, what we are speaking about. This exchange with governments and development banks from asset managers is already there. It has been approximately 750 billion in size that went into climate kind of transition assets, which is only 1% of the market capitalization. So that's actually really nothing. And if you compare it with the sustainable investments of 35 trillion, okay, 700 billion versus 35 trillion, it's a huge, huge mismatch where this reallocation should be really a substantial one going forward. Anybody else? In that case, thank you very much. Enjoy the rest of the evening, and we are here. Father, thanks.
Thanks very much, Thomas. We are almost there, but possibly the key panel and the key discussion of this conference is still ahead of us. As mentioned at the very beginning, we'll be having this discussion in Polish, but let me give you a brief introduction in English to what we'll be talking about and why it matters so much to us. Well, the passive investing instruments industry is growing rapidly worldwide, and this trend has certainly reached Poland. And I'm glad to hear from the discussions with our partners that they see it this way as well. Well, the statistics show that the market for exchange-traded products in Poland is experiencing a significant surge. For instance, the market capitalization of local ETFs is increasing every year, and the trading volume has quadrupled between 2019 and 2022. There are currently 9 local ETFs and 2 foreign ones available on the Polish Stock Exchange. On the other hand, more and more brokerage firms are expanding their offerings to include foreign products that are accessible to Polish investors, and they now offer several hundred products in Poland. Despite this promising growth and significant educational efforts, research conducted by the Warsaw Stock Exchange Foundation indicates that only the small percentage of investors who are actually familiar with the ETF's concept itself. On top of this, Poland is probably the only country in the European Union where the local ETFs are non-UCITS compliant and function as alternative investment vehicles. Whilst there have been plentiful discussions and publications regarding this issue, there appears to be a certain inertia when it comes to alerting this state of affairs. The world is moving forward, and passive investing has already entered such areas as responsible finance that we heard a bit before, and latest technologies, including obviously the world of crypto. What are the prospects for the development of the Polish passive investment market? Why are passive investing instruments so important to us and perhaps even our economy as a whole? And what specific actions, besides education of course, can be taken to make the passive investing in Poland more attractive to issuers, brokerage firms, the stock market, and most importantly, investors? It'll be my pleasure to pose these and some other questions to today's panelists, experienced capital market experts, who each combine local, practical, and international experience. Dear English-speaking guests, while this panel will be conducted in Polish, please do not feel discouraged. You are still invited to ask any questions regarding the Polish ETFs market after the discussion, and please reach out to us during the break and the networking session. We promise to answer in English or provide translation whenever needed. Moreover, we're having this networking session and the conference toast planned right after our panel, and I'm confident the language barriers will not prevent effective and efficient communication then. Szanowni Państwo, witam na ostatnim i kluczowym panelu. Excuse me. Tak? Confirm? Iza, tak? Dobra. So there's been a very slight change of plans, but to the better. It's always a change to the better. So let's have the panel in English. Very well. And let me invite, and I'll then introduce my distinguished guests. So Mrs. Izabela Olszewska, the member of the management board of the Warsaw Stock Exchange. Ms. Katarzyna Szwarc, High Representative of the Polish Ministry of Finance, responsible for the implementation of the capital market development strategy. We are also having Mr. Robert Sochacki, CEO of the Beta Securities, the Polish ETF issuer. Mrs. Ewa Mazurkiewicz, a very experienced lawyer, head of capital markets and one of the leading Polish law firms, who was involved in the issuance of the first Polish exchange-traded funds. And last but not least, Mr. Maximilian Skolik, director of the mBank brokerage house. mBank is a partner of our conference. Very good to have a chance to improvise. Why don't we start with our stock exchange then? And so the world is moving forward, and ETFs are becoming more and more popular. And we see that here even by the size of our conference, that is growing year by year. And we see a real interest from both institutional and individual investors. But maybe it's not obvious for everyone why are ETFs and passive investment vehicles in general so important for the stock exchange, for our indices, and possibly for our economy as a whole. And I would like to ask this question to Mrs. Izabela Olszewska. If you could give us the stock exchange perspective and possibly also the market perspective on that.
Good afternoon. Thank you very much for this question. So, yes, of course, as the representative of Warsaw Stock Exchange, I would be more than happy to provide you with the perspective of our stock exchange, and maybe I will look also a little bit globally, and I present my opinion from the perspective of the capital market in Poland. So, as we could hear about the ETFs, there are very good instruments, and we can see that the growth of the interest in ETFs. We have 9,000 different ETFs listed worldwide, and I would say that the asset under management, they grow rapidly. So as Warsaw Stock Exchange, we compete a lot about the interest of investors, both categories, or maybe three categories of investors. So retail clients, institutional, local institution, and the interest of global investors. And we can see that the world currently is fully electronic and global, and our investors, they can trade on other stock exchanges. Also, it's very open for retail clients to invest abroad. So it's absolutely normal that as a platform in Poland, we would like to have the good palette of our products, of financial instruments, and keep the local capital, and also encourage the global capital to be on our platform. So this is the first reason, as we would like to promote ETFs because we can see that the experience globally is that the investors, they are more and more invest in this kind of instruments. This is the perspective of the investors that are currently with us, but also in Poland we have only 1,600,000 accounts. So comparing to the huge number of Polish citizens, we can see that we have the potential to bring the completely new investors to the capital market. And in my view, ETF could be first instrument for these categories of clients who are maybe not experienced enough or not educated enough to just invest in a concrete company or stock, or I don't mention here derivatives or other advanced instruments. So I think that it could be a very good instrument for also for the beginners. For the institutional investors, of course, we can also observe the increasing interest of our local funds, especially also pension funds that can invest in different ETFs. So our interest to have all these instruments here on our platform. The other perspective is more global, and we can see, for example, from the example of Israel, and maybe the representative of Beta Securities will explore this topic more, but we can see that the ETFs, they have the very good impact on the whole capital market and the whole stock exchange. Because if you have the ETFs based on Polish indices, and we have some of them, so every movement, so I mean the creation or redemption, it is connected with the movement on the real stock. So I think that having a vibrant market of ETFs for sure will help with building the liquidity on the stocks which are included in the indices being the underlying for ETFs. So from this perspective, we think that this is absolutely the interest of Warsaw Stock Exchange to promote this kind of instruments, and we've been involved in the promoting for a couple of years. Of course, as it was already mentioned by the moderator, and probably will elaborate this in the couple of minutes, we have some barriers in our legal framework, but we would not want to defend, and we try to create the best possible framework for these instruments in Poland.
Thank you very much. I'd be eager to move to Beriasz right now, but since we mentioned Mr. Robert Sochacki and Beta Securities as the local issuer, we've got quite a few individual investors following us at the moment, and maybe it's not obvious to everybody. How does it actually happen that an ETF is such an important instrument from the perspective of its structure, of its performance? We all know that by definition it requires a market maker, so there are several trades following a trade on an ETF. What is your perspective as a person who structures this instrument, having also the local background of how you're doing it here?
Thank you. First, good that we didn't change the language of the previous panel to Polish.
We were almost there. You were almost there.
Okay, so next time Thomas is speaking Polish. Okay. First, I think to answer directly your question, ETFs, similarly to derivative instruments, since they have very strong connection with the cash market, the turnover on ETFs generates few times more turnover on the cash market. First, if someone is buying an ETF, let's say 1 million, then you have market maker that is selling it, must hedge itself, so there is another 1 million that is done on the cash market in the moment that the market maker is selling the ETF to the investor. Then, when there is a creation at the end of the day, again, the market maker is selling the hedge in the market and creating the ETFs, and the ETF provider or the fund itself is hedging itself, so it's buying the underlying asset to invest money. So it's effectively it's 4 times the turnover of the ETF. That's the effect on the turnover on the stock exchange. There might be slightly different scenario if you have in-kind creation, but let's not get too much into details. Generally, at least in case of our market, and the standard on our market is a cash creation, you have 4 times the turnover on ETFs, the turnover on the cash market. So it's highly effective or profitable, or I don't know how to call it, type of transaction for the stock exchange and for the investors for the liquidity on the market. So, so ETFs have certain characteristics that are much different than just trading stocks. And that's one thing, but I think even more important is the fact that if you have ETFs introduced on your market, like in our case on the Polish market, WIG20 is liquid itself. So there is no special feature of ETF on WIG20. But if you have ETF on MWIG40 or SWIG80, which are mid caps and small caps, every creation results in, as I said, first buying the fund, some transactions to hedge from the market maker, and then at the end, the fund itself is buying stocks from all these individual companies. So we have small bits of liquidity in all the stocks that without ETFs were probably never touched because the interest of the bigger investors concentrates on the most liquid parts of the market. So when we have active ETF market that covers not only large caps but also small caps and mid caps, you have a little bit of liquidity in other parts of the market, which increases the attractiveness of the whole market. Because now, when you look at the ETFs that are available from iShares, for example, on Poland, MSCI Poland, you have either several companies that is less than 20 in one of these ETFs, and in the other one you have 20-something, or around 30, which is also only concentrated on the largest companies. So if we get to the point when ETFs on small caps and mid caps increase the liquidity on the other parts of the market, we will also see maybe the interest of the foreign investors that are dominating, at least at this point, they are dominating the local market in terms of turnover. Maybe we will see also them investing in other areas than just the large caps.
Thank you very much. If only we had a bit more of these Polish ETFs. And that leads me to another question. And for a brief introduction for our English-speaking guests that are not familiar with the Polish legal and regulatory system, as mentioned already, we're probably the only country in the EU that our ETFs are non-UCITS ones. And it's been and this situation has been dragging on for quite some time. That results in certain obstacles for them to develop, meaning obstacles for our markets and the smaller indices, as mentioned by Robert. I would like to ask Ms. Ewa Mazurkiewicz, on the legal perspective of that, where did it all begin? Why do we actually need to struggle with it? And why don't we really see an end to that in the near future?
Thank you very much for this question. When was this the beginning of the story? The beginning of the story was in 2004, or even earlier, when the provisions, as they are now, were started to be drafted. This was, as a matter of fact, the beginning of ETFs in Europe, because ETFs in Europe, as I know, however, I can be corrected by my colleagues, they started to be traded at the beginning of our century, of our millennium. And that's the more or less time when our legislators started to draft our Polish provisions on Polish ETFs. They actually had some slight idea of ETFs in Poland, how they should work. They had this division between open-ended funds and closed-ended funds, and the funds that sell units which are not tradable and certificates which are securities and are fully tradable. And they decided, they could decide, that Polish ETFs should be created as closed-ended funds and issue certificates which can be traded on regulated market. Provisions regarding ETFs were very poor, I would say, and they more or less in the form they were drafted at the beginning, they are still in the same form. This is good and bad at the same time, because normally we could use those general provisions and could interpret them in a way to create normal ETFs, no matter this issue of closed-end investment fund not being a UCITS fund. However, you know, I can't say anything more that it's not really possible when you have an authority which interprets every provision in a very strict way. However, we have this general, very important problem with closed-end investment funds, because Polish law just says we have open-ended investment funds and closed-ended investment funds, no matter the features of the fund. European Union has some criteria which has to be followed to qualify the investment fund as open-ended or closed-ended fund. Moreover, UCITS is defined as the fund which gathers some funds from investors and then invests those funds into securities and other liquid assets as defined in the law, and diversifies risks related to those investments. Okay? Oh, yeah, that's better. So UCITS is defined in the law as the fund which gathers the funds from the investors and invests those funds into securities and other liquid assets defined by the law, and at the same time diversifies the risks related to those investments. That's all. What is stated in our law is stated that our UCITS is always open-ended investment fund. That's it. And every other fund is specialized investment fund, which is still open-ended. And all closed-ended investment fund, no matter the investment policy, is always alternative investment fund. No matter the redemption policy, no matter the investment policy, every time we have so-called, called by the law, closed-ended investment fund, we have the alternative investment fund. Most of our ETFs have the investment policy compliant with UCITS, have the redemption policy which is pursuant, which is compliant with the one defined as the adequate for the open-ended investment fund. Why our ETFs cannot be UCITS if they are UCITS compliant? Because they are qualified by the law as closed-ended investment funds. That's the only reason. There is another consequence. According to the prospectus regulation, this regulation shall not be applicable to any other collective investment funds, let's just skip this collective thing, other than the close-ended. Should not. But how we should find out whether the fund is closed-ended or open-ended? We should try to find out whether all those criteria are met. Not like in Poland, we should look at the law and try to find out whether the law specifies that our fund is named close-ended or open-ended. No, that's why we prepare prospectuses every year, go to our Polish authority to get the prospectuses accepted. That's because we have funds named by the law as close-ended. However, we have this continuous public offer. Okay, sorry. We have this continuous offering of our certificates. We have continuous redemption. We have investment policy, which is compliant with UCITS directive. And still, we have to make our prospectuses. That's why we say our ETFs, most of our ETFs, are UCITS. They should be UCITS. They should be treated like UCITS. And our investors should know that they are UCITS. It's not just terminology fight, because there are further consequences. If you are UCITS, you are not complicated instrument by law for distributor who is obliged to make adequacy for his clients, who is obliged to make product governance, selling instruments. The law treats UCITS completely differently from close-ended investment funds. Sorry, not close-ended, but alternative investment fund. Alternative investment funds are treated like risky instruments. That's why investors are not willing to invest their funds into alternative investment funds, even if they look like ETFs, because ETFs, which are UCITS, are completely differently treated under any risk analysis. That's one consequence. Another consequence is when you have your investment limits. Investment limits are different for investments in UCITS and investments in alternative investment funds, even in Polish law. For instance, for investment funds, there are many consequences which are different for UCITS and for alternative investment funds. This is the essence of this fight. And like I said, the story began in 2004. Nothing really changed. We created 9 ETFs. We're still fighting for the change of law for those ETFs to be treated like normal UCITS, as they mostly are. That's more or less the story.
Thank you very much for this comprehensive description. So it appears that it's a very unfortunate mix of legislatory provisions and regulatory approach. But let's not lose focus here. And maybe I'll try to do a bit of a twist now. And so we've got this unfortunate regulatory situation. But from the practical point of view, and I see that we still have representatives of our partners here, can I ask some of you a question? Tomasz, if you don't mind. Does it make sense to you? I mean, you're doing this business, you're selling these funds. Does it make sense to you that an ETF is non-UCITS? and that this is a closed-end investment fund. Yeah, pomożesz, Haniu?
I've been trying to be really honest the whole afternoon today, so I will keep at that. I don't really understand it. I still don't understand it. I'm really struggling with the rationale, but maybe it's not only Poland relative, but European Union. Because we have got a kind of a financial union, European Union with a, I would say, guidelines on ESMA, on UCITS, on different regulations. And still we have the regional implementation on a completely different level than what I think the idea of this legislations I think meant to have to be. Poland is completely different from everybody else, and that's maybe making our lives really hard to understand that and to move in this direction. And as what I have heard also from the competition, it wasn't really easy to kind of get access to the market in terms of really offering the products here also in the retail space. So I don't think it's a really good answer, but it's at least what I'm struggling with still.
Thanks very much so much. Yes, indeed, we should congratulate Bahram of introducing 180 iShares funds to the Polish register. So yeah, the only word that comes to my mind in English is possibly conundrum to describe what we're challenged with right now. But maybe there is a light in the tunnel, or at least we've been thinking there was, as we've got quite advanced legislation introducing the changes related to the implementation of the capital market development strategy. And this is for our English speaker to, just so you know, several years ago, European Bank for Reconstruction and Development with the representatives of the Polish government, I'm simplifying this a bit, came together to identify the most pressing problems for the Polish capital markets to develop. And ETFs legislation was one of them. And we are now, a few years later, we are having the relevant draft law being proceeded by the Polish Parliament. And initially, it included some very promising changes. And we were all hoping that the local ETFs will eventually be UCITS compliant. I understand it's changed a bit now, and this is obviously the question to Katarzyna Szwarc. If you could let us know where we are now and obviously what the prospects are for the near future.
Yeah, thank you very much for the question. And first of all, let me thank you very much for the invitation. I'm really incredibly happy to be here. To be honest, when I reflect on the first days at the Ministry of Finance when I took office, people kept asking me, okay, so we've got all those huge challenges ahead of us, like we need to improve on financial education, we need to build better mechanisms that can help us translate savings into investments like pension funds, etc. But these obviously will bring us impact in 10, 15 years. Are there any quick wins that we can have, that we can really show the market that the strategy is working? And I said, yes, of course, ETFs. It's like the trend is so big that even politicians have noticed. We see that investors are really, really interested. We see that the solution is cheap, it's simple, it's transparent. It allows them to invest in what they most care about, like ESG, or what they are interested in, like gaming. So there is a lot of potential, and I fully support the stock exchanges and the Polish capital markets efforts to improve the situation. Now, as Eva shrewdly observed, we have this, let me say, challenging situation in the Polish law. I think the way I understand it is that the Polish investment fund law actually precedes not only the European solutions, but also ETFs. which creates several challenges. First of all, it's challenging to adjust it legally, but we already had suggestions on how this could be done. So let's say that this challenge, we've overcome it. But the bigger challenge, the second challenge, is it creates this psychological barrier in the market amongst regulators, some policymakers, that we would need to classify ETFs that are for some reason considered closed-end funds in Poland as UCITS. Indeed, the initial version of the draft bill included some brave solutions that were quickly made subject to a wide debate, which ended in something that I guess we can call a compromise. Something that no one is apparently happy with, but apparently that is how you define success in the government. But it makes important steps towards actually easing the situation for ETFs here in Poland. So several regulatory obligations that are, I understand, a problem and a big cost to ETF manufacturers in Poland are being removed. So at least we're moving slowly, but we're moving towards this perfect model. The bill is currently, we have finished working on it at the Ministry of Finance. It's been submitted to the Chancellery of the Prime Minister, and we hope that within the next couple of weeks it will make its way to the Parliament, where it can be approved before the end of this term.
Thank you very much. So, what are these steps in particular, and does it mean can we be very hopeful or a little hopeful? Does it mean that we will have this UCITS label in the few weeks' time, few months' time, or does it mean that we will have some steps forward, but we are not quite there yet in terms of the UCITS sticker?
Well, so the UCITS sticker is not there. It's not in the draft bill. The way I see it is that we're taking important regulatory steps towards easing the situation for the Polish UCITS. Hopefully you agree with me, Robert. We are taking important steps towards actually changing the thinking around ETFs in Poland. And to be honest with you, I think it's just a matter of time.
I very much hope so, and this sounds reassuring. Thank you very much for explaining this. And this, at the end of the day, it is a bit of a good news, at least for now. I would like to park the issue of domestic investment funds for a little while, as we have still with us our partners today, and your funds are being offered to the Polish customers, not necessarily via our stock exchange, which is a bit of a shame, but are being distributed in several other channels, meaning, for example, mBank. And I kept Ms. Maximilian's colleague silent for a little while, for which I apologize. But if you could tell us a little bit more, you've got a gigantic offer of ETFs and other exchange-traded products, over 400 instruments available to Polish investors. What are we've discussed trends worldwide, and we know what's going on more or less. How do you see the demand of Polish investors? Of course, being able to offer lots of instruments, it gives you lots of data. And are they all so popular, or do we, as Polish investors, concentrate more on some of them?
Good afternoon, and thank you very much for parking this difficult regulatory issue. And I'll be happy to concentrate on slightly more practical aspects. And yes, we have been the first one in Poland to introduce foreign markets and ETF trading. And we've seen the development of the offer over the last few years. It's been a huge success, very dynamic growth. And I think it really started at the end of 2019 and speeded up in 2020 and 2021. I think that was where the most dynamic growth was. And yeah, preparing for that panel, I had a look at what our clients are interested in, and I would be happy to share some insight into it. So I had a look at top 20, 25 ETFs they trade, and it's retail clients. And I may say that approximately 17% of our retail client base already has exposure to ETFs, which I think is quite a lot given that we've been in the market for over 30 years. So this is not like a fresh client base. We've built that client base over many, many years. And we have seen very strong acquisition in those, let's say, pandemic years, 20 and 21. And these were like new clients. They were younger, definitely more prone towards investing overseas. And it seems that, trading foreign stocks, single stocks or ETFs was not a problem to them. And we all know that, there's this strong home bias when it comes to investing abroad. So it's really difficult to go over a certain level. But coming back to the offering, I think I can try to split it into 4 or 5 categories. So the first one would be ETFs giving very wide exposure to stock indices, like SWDA, for example. Maybe it rings a bell. It's the most popular one in our offering. And I think we have a few thousand clients with exposure to this one. Definitely by far the most popular. I think it's based on MSCI World Index, if I'm correct. So developed markets, approximately 85% of coverage. Then there's like 2 more. I think SPY5 is, for example, one of them. So basically the first category is ETFs that give you a highly diversified exposure to global markets, global stock markets. And the second group is, I would say, still ETFs giving you exposure to stock indices, but in a narrower meaning, like, for example, only to, let's say, China, or also very popular, I think it's Vanguard Lifetime 80-20, which is a split between equity and bond part of the portfolio. I think we also have, it's probably the second most popular, if I recall correctly, EMIM, EMIM, to be precise. It's emerging markets ETF, concentrated primarily in China and Taiwan. I think China is like 28%, Taiwan 17% or something like that. So it's also very popular. The third group, I would say, is commodities. That may be slightly surprising, given this is the passive investing conference, and yeah, but I think it's. I think we have like 2 groups of clients in this category. Clients that try to speculate, so it's like more, shorter, medium-term speculation, and clients that want to have exposure to gold. As I should have said that earlier, gold is by far number 1 in this commodity category. So altogether in the top 25, I think we have like 3 ETFs with exposure to gold. So, still it's very popular, and I think especially now in the high inflation environment, I think clients tend to, flock towards safety they perceived, with having exposure to gold. And if I were to give one advice to my colleagues from Beta, where they should be looking for the best asset class that would be of interest to retail client, gold would definitely be one of them. So other positions in that commodity category would be like silver, platinum. I think if I'm correct, oil was at at the bottom, but oil is like, highly speculative commodity. So that would be category number 3. The next one would be thematic investing, and I think we had quite a few of them in the top 25, like 10 or so. So, water, clean energy, cybersecurity, automation and robotics. So usual suspects, I would say. And that's not really what we have in mind when we think about passive investing, because these products may be perceived as speculative addition to your portfolio, like, giving you exposure to part of sectors or sectors that are only developing, and they have some inherent speculative nature in that. And I would highly recommend the thing that Michal had yesterday regarding thematic investing. You can watch it online if you haven't seen it yet. I highly recommend it. So there are some pitfalls to thematic investing, definitely, but it seems that clients like that attitude of having like, core portfolio and some satellite portfolios or parts of the portfolios that gives them like, additional exposure. And the final group, I think, is what we may call Warsaw Stock Exchange listed ETFs. Let's put it this way, because all the ones that I was discussing previously are available through foreign brokers, so in our foreign markets offering. And in this last group, I think we had Lixor S&P 500, which is, if I'm correct, like the oldest one, or maybe one of the oldest ones that we have. The oldest, yeah? One of the oldest, okay. And 3 beta ETFs for VIG 20, MVIG, and I think the leveraged VIG 20 was the last one. So yeah, basically, if I were to try to put them into categories, that would be those 5. And
Thank you very much. I mean, this is very interesting because it means that Polish investors are actually tempted to have quite a diverse portfolio of products as well.
yeah, definitely. So it's not concentrated in Y group. I would say it's spread over like, very different asset classes, asset types, etc.
And life strategy that you mentioned is Vanguard. Yeah, very interesting. And a short follow-up question: commodities? Did you mean ETC commodities, investing in gold itself, or gold miners equities, or both?
I think the 3 of them that I saw on the list were ETFs with exposure to either physical gold or exposure created by derivatives, but it wasn't miners, it was exposure to pure gold.
Pure gold, thank you. Yeah, so moving on to different distribution channels, because we've got our stock exchange, we've got brokers offering foreign products, but there is also a bit of a trend, at least on the local exchanges, and we see that in both Bulgaria, for example, that they open global markets and introduce foreign products to their stock exchanges. We don't have such a large offer for that at the Warsaw Stock Exchange yet, but possibly it's a very interesting and attractive distribution channel for the investors and for the exchange too. And this leads me to come back to Ms. Izabela Olszewska to tell us what, does it actually even make sense for investors to have these foreign UCITS ETFs available via our exchange? And what are the plans of the Warsaw Stock Exchange in this respect?
As the stock exchange, of course, I think that is absolutely obvious. We are interested in those ETFs who could be traded on our platform. And of course, on the one hand, it's just our business. But on the other hand, I think that we need to give to our investors I think the huge range of possibilities. So there are some of them, they want to trade abroad on foreign stock exchanges. Some investors, they come from abroad to us. So the world is connected, full electronic, no problem. But I think that there are a group of investors, or maybe potentially new investors, who feel better on our local exchange. They want to trade in Polish currency, and they want to have the access through our local brokers. And I think that it makes sense also to have a range of ETFs here on Warsaw Stock Exchange. So every day with my colleagues, we ask ourselves the question, how we can achieve it. So what are the potential channels of bringing new ETFs to our platform? So first possibility is, of course, to develop the ETFs which are created on the basis of the Polish law, but and of course we support beta ETF and we just want them to develop the offer. But of course we could hear about some challenges and in our local legislation, and we need to overcome these barriers, and I hope that one day we'll manage to do this. So this is the one thing. The second thing is how to bring the ETFs, which are created on the basis of the foreign law, to our platform. And there are two, I think, possibilities. One is just to encourage the foreign providers to be our issuers, but it is a challenge. And what we've been observing for a long time, that the answer is no, we want to have this ETF listed and traded on the global exchanges, and we don't want to have, those ETFs and the liquidity spread on many exchanges. So the other possibility is to bring this ETF without, the whole procedure and the agreement of the providers, and this is possible. And a couple months ago, we opened our Global Connect market. Currently, we have just a few stocks, blue chips from Europe, which are offered to our clients. And of course, I think that this is, for us, the possible way how to also bring the foreign ETFs to our markets. And a couple of years ago, I used to work for Acquis Exchange, which is the entity, the platform located in London and currently also in the EU zone. And they offered a lot of ETFs to our clients, like a multilateral trading facility, and they were very successful. Also, Marcin, you mentioned some other countries, like, for example, Bulgaria or Austria, and they have also such an offer to their investors. So currently, we are in the process of checking whether it is possible also in our Polish circumstances. But this is the third, I would say, channel for us to bring ETFs and increase the palette of ETFs on our market. What is the good news? That we managed to find outside the first interested ETN and ETC provider, and we are in discussion. This is the big name in Europe, and we are in discussion of them. So as soon as we have agreement with the market makers, so probably we'll have the first ETC and ETN products on our platform.
Thank you. So there's lots of interesting news ahead. we're running out of time, but I'd still like to ask a couple of maybe shorter questions. So Beta introduced quite a few interesting ETFs recently, and it's been quite of a journey. How do you see this advice you just got, Robert, to have the ETC fully physically backed gold instrument, which will not be possible under the Polish law for the moment, but hey, maybe gold miners for Polish or something similar, which is obviously a broader question of what are your plans now to develop and introduce a new instrument?
Sorry. Of course, we are looking at new products. We've introduced in 2021 5 new products. They are slowly gaining the assets. It's a challenge to fill the products with the assets that we have already, but we are looking at new possibilities, and definitely commodities is one of them, because we've introduced, the last one that we introduced was Polish government bond ETF, which is different asset class that we were doing so far. And again, it's not growing as good as I would imagine, but I think regardless of the speed of investing, we are here for the long time, and we will be introducing. The law changes or not, we will be introducing the ETFs, and we will not be discouraged by alternative funds or UCITS or whatever. So definitely we will introduce a couple of new funds. We will probably this year we will introduce them. We are looking at, of course, the big questions are which asset classes. The second big question is domestic or foreign indices. And definitely we see that there is a demand for thematics, for gold, but we also see that. Sorry. Dividends. We see that, but we also see that there is, thanks to mBank, Bosch, and others, we see that there is access for Polish investors for this kind of ETFs from other providers that so far we treat as our colleagues and hopefully helping in development of the local ETF market. So I think there is enough room for us to focus also a little bit more on Polish market and Polish indices. We are working with GPW Benchmark, which is an index company of Warsaw Stock Exchange. And they are introducing new indices also for the Polish market. And we see also ourselves as providers of the solutions for the Polish investors. So with the Polish, let's say, or home bias, with the home bias of Polish investors, we see some opportunities for Polish indices. So I would guess that we should expect, or I think investors should expect, we should introduce something from the Polish market rather than gold that is already available, and investors like, for example, physical gold, and also possibility to redeem in physical gold, which is probably very difficult for us to replicate. So it doesn't really make sense. we see that there is a fight to be fought on the area of regulation that can invite, let's say, or make it easier for others to also issue on the Polish market. I would friendly disagree with Eva about what she said about that in 2004 it started and nothing has changed till now. We have one thing that has changed, which is we have Polish ETFs now. So we have verified the regulation that was done in 2004. So far it seems that we look at it in a way that if reality doesn't fit the regulation, it's worse for the reality, not the other way around. So we're hoping that at some point the regulator will understand that if we have some experience from the real life and real market developments, we should adjust the law to help the development, not the other way around. So we should, buy too small suit and try to fit it. We should rather make a new suit if it doesn't fit us. So I hope that this will be done because, however we like the global market to be present in Poland, we also should understand that in every European market there is a strong home bias, and there was many surveys done on that, and in most of the instances, in majority of the investors never even think about investing abroad. We in Poland have a little bit skewed view because only 4% of Poles know what ETFs are. So we think that the behavior of Polish investors is kind of representative for the whole population, which is not. We have 4% of people that have brokerage accounts that are active on the stock exchange, and we cannot make projections on the basis of these investors with regard to the whole population. When we have 40 or 60% of people knowing what ETFs are, we will have completely different behaviors. We will see people investing in MVIC, SVIC much stronger than S&P 500. Although I love S&P 500 and I think it's a great index, and Americans and all the world loves it, I think majority of the Polish investors will be investing in small caps, mid caps, and large caps of Polish stock exchange. They will have certain part of their portfolio invested abroad, and hopefully it will be a big part. But I can't imagine that when we have 60% of Poles investing on the stock exchange, 60 or 70% of their money will be invested abroad. I think 60 or 70% of their money will be invested domestically, and only 30% will be invested abroad. So S&P will stay, or NASDAQ will stay as an important index. But if we get to people that are more representative for the whole population, I think we will be more focusing on the domestic market. And if we manage to grow the importance of stock exchange, importance of the long-term investing, we will also attract other issuers. I wouldn't exclude also those from abroad, to create ETFs in Poland on Polish indices if they manage to be important enough to attract foreign issuers and foreign investors. Now, the foreign investors invest in MSCI Poland, not WIG20 or MWIG40. But I don't know, maybe, as I said, we managed to change the market, the structure of the market, in a way to attract more investors, retail investors, to the market. We see Slovakia, we see Czech Republic, how they managed by incentives, tax incentives, to shift some of the savings from the banks to the stock exchange. And it's hard for me to imagine that in Slovakia you have more ETFs sold to retail investors than in Poland. That is the level of the challenge that we are facing.
Thank you very much. So there is obviously lots to be done, but we will have new beta ETFs. So I have an impression that I should keep on asking because each question brings some good news. And on that note, yesterday marked a very important day for the crypto enthusiasm and passive investors, because some of you may not have recalled that it was the first official exchange-traded product based on the MSCI crypto index was yesterday listed on Xetra. And this is a question that will surely be very important for lots of the individual investors that are watching us now, and that I would like to ask to Maximilian's colleague. We're having this, and also like last Thursday was when Mika got blessed by the European Parliament. Judging from not only the knowledge of the market and Polish investors, but also your entire investment experience, can we actually say that crypto is a new asset class? And if so, what is the chance of crypto-based products? Can we even still call them passive investment products, but exchange-traded products offering crypto exposures? What is the chance of them being available to Polish investors via any distribution channels, be that mBank or other brokerage houses? What would need to happen? What would need to change for this to happen?
So maybe if you don't mind, I can briefly comment on what Robert said just a while ago regarding his optimism towards Polish market. Unfortunately, I can't agree. I think that data that we have seen over the last many years, they show that Polish market does not produce good returns, and it's much better to invest abroad, unfortunately. I think that the growth and the client interest will be concentrated in the foreign markets, primarily developed markets. And Polish market will definitely not be the first choice, and that is what we are seeing now. And I can't see how that would change, to be honest. So that's basically my comment too. And
it's good that there is at least one thing that we quite strongly disagree within the panels. It's energizing.
Okay, so...
but please, my crypto question first.
Okay, so going back to crypto, yes, definitely we have seen interest from the clients, and I think we would be offering that kind of products, but unfortunately there is no regulatory framework in Poland to support that, and we have seen the growth of such products in Germany. There is many of them listed on Xetra, and you have issuers that specialize in that kind of products, like CoinShares, I think, 21 Shares, if I recall the names correctly. And the offering is quite wide, and trading is growing. So definitely there is strong interest into it, but also there is regulatory framework in Germany that lets these things happen. And definitely it's not the case here in Poland. And as you mentioned, the parliament accepted MiCA, but I think it's going to be towards the end of 2024 when it comes into life in the member countries. So I think we just need to wait for the regulatory framework. And we have also, from the regulatory perspective, we have also heard what the regulator thinks about crypto, and I personally don't perceive that as positive news, to be honest. So I think it's going to be primarily wait and see approach till we have the regulations, And then hopefully we can satisfy the client's appetite for that kind of products.
Very well, thank you. So hopefully when the regulatory framework changes, then you'll be there to offer the products. This is good to know. I have one possibly final question, and this is, why don't we end up on the ESG note? This is a question I would like to ask Katarzyna Schwarz. Not everybody knows that she is also the well-regarded ESG expert and an author of first Polish publications on the green finance in central banking, as far as I remember. So if you were to comment also on the ETFs in the ESG sector. Of course, it's one of the thematics that we discussed today, but I hear from lots of people that when investing, they also want to make a bit of a vote and invest alongside the values. And maybe this is an instrument that could offer this to them. What's your take on that?
Yeah, absolutely, fully agree. As you know, at the Ministry of Finance, since last year, we've been working on a roadmap for sustainable finance development in Poland. The idea is to not make it a compliance exercise, but more to think how the Polish capital market can really develop on the basis of this new ESG phenomenon, on the back of the fact that Poland will need so much money for financing its just transition in the years to come. And in each meeting of working groups and the platform and the sustainable finance platform that we launched, we hear investment funds, including ETFs, are a way to do it. I think ETFs could be, in many countries, global markets already are a smart way for investors to invest in what they care about: climate change, social issues, maybe ESG aspects, incorporating also the corporate governance. And I think I don't know. I'm sure you've noticed in the last couple of months there's been actually the number of ESG labeled ETFs have decreased. As a result of regulations coming into force, which actually enforced certain standards on what can be labeled as climate change friendly, as planet friendly, as green, or as ESG. And I think this is a really, really good phenomenon, because what this actually did was to make investors sure that the ETFs that the green or ESG or sustainability labeled ETFs that they invest in now, that are out there, really can help them make that impact they are looking for. So I think we're actually on a good track, and obviously fully agree that ETFs are a good instrument to drive that change.
And do you see appetite in Poland for that? We possibly are not quite there yet. Or are we?
There is one investment fund that follows the ESG index in Poland, and it's pretty big, 1.5 billion zlotys, which is for Polish standard big. The only problem is that it wasn't ESG when it was 1.5. It changed to ESG and it's still 1.5. So I don't think there is an impact of being ESG to big extent. I think it's just the inertia of the investors. But still, there is some interest or at least lack of dislike from the investors.
Well, you need to start somewhere, yeah?
Quickly at Votum, because
Please.
I think I do see that wine is being served there, and I would definitely not like to deprive our audience of it. But I think the main challenge at the moment in Poland is that we don't have low carbon benchmarks. But we are working intensely on this to change in the months or years to come. So definitely watch this space. I think they will make it much easier for Polish sustainability ETFs to be launched.
Thank you. Considering the wine, and not only, I will conclude this panel now. Thank you very much to my esteemed panelists. I hope it was very informing for our partners, and your desire to know what's going on in Poland in the passive investment sector is at least satisfied to an extent. Please, big applause to the panelists. Thank you very much. Well, dear guests, partners, and participants, this closes the official part of our conference. And I hope you found today's discussion about passive investments to be insightful and informative. Without further ado, please help yourself with some wine and refreshments, and we'll be very happy to host you next year.